Remember when I got hired at Quick Trip back in 2010 to be an overnight assistant manager? And picture it's 4:30 in the morning. My manager comes in at 5. That's how we need to think as long-term investors. And that's the magic of being a long-term investor. I'm just overlooking my companies, making decisions. I understand if I sell a stock for a loss, you know what it was? The more money you have, actually, the more important it is to think like that. What are we playing this game for? I still think about myself as I don't have much money. I still think of myself like that. Hope is not a strategy in the stock market you can ever do. In the stock market, you need to be confident that your company is making the right decisions, headed in the right direction. Wall Street's gonna love, again. This always was a very loved stock by Wall Street. One of the most attractive opportunities I see in the market. Don't be surprised if I'm making 6 figures plus a year, if not multi-6 figures from just dividends. Next stock I bought here today is... Holy smokers, ladies and gentlemen, we're still alive. We're still posting on YouTube. We're surviving out here. Appreciate everybody joining me here today. Okay, we got a lot to get into in this one. Public account, great day here today, up $39,000. This public account has come a long way. It was just barely over $1 million if we go back 3 years ago. Today, to now see it at 3.7 plus million is, man, this is thankful. But you got to think sometimes, where's this portfolio going to be 3 years from now, 5 years from now, 7 years from now, if it's made this much progress like this, right? It's incredible to think about. We have some major strength going on. Look at AMD. AMD stock for me in the public account today was up $34,000. $34,000. That's major strength here today. Palantir showed a lot of strength here today, up $7,900 on that one. Alpha $3,000 move there. SoFi 4,300. Celsius 3,200. A lot of big movers here today. Google remains strong. Cheesecake all of a sudden recently has started to show some strength again, finally coming back to life. 5 core subjects we're going to speak about here today. First up, why long-term investing, right? Why do I do what I do on a daily basis? I need to explain that so everybody understands that at the beginning of this video, because I don't think a lot of people get it, and I want to explain it, okay? And how do I think about this? Second thing is, what you must do now before the end of 2025, before we get into 2026, in regards to, thinking about your portfolio and, let's call it some tax strategies as well, and kind of, I'll run you through that. Third thing is Oracle stock? Is it an opportunity right now? I want to speak about that. I think it's an important subject. Fourth thing up here, my favorite software stocks for 2026 and beyond. And then fifth subject is Nike. Obviously, that one is a very controversial stock right now. So looking forward to sharing my opinions and perspectives there after the earnings, the downward move, all that good stuff. Okay. One thing only I need from you guys, if you do like the sign in my garage says, and just hit that little thumbs up button, that would mean the world to me. Everybody that's already done it, thank you so much. If you want to be here, subscribe to the channel. You can hit that subscribe button and subscribe to the channel. We're 908,000 subscribers now at this point in time. My private group is closed right now, ladies and gentlemen. It is closed. However, if you want to jump to the front of the wait list when we do reopen at some point in 2026 to join us in there, that will be the pinned comment down there. Alrighty, ladies and gentlemen, I have a picture of the earth there. Why? I have a picture of the earth there because when we're thinking about long-term investing, you've got to zoom out. Imagine you're an astronaut, you're in outer space. I think something about that would make you think differently, right? Because you think about, you're just viewing Earth from above, and you're thinking about all the humans down there and all the short-term things that are going on, right? You're thinking about, you might be thinking about this, you might not be thinking about this. Somebody is mad at Starbucks right now. Somebody messed up their drink. They're upset. How could you do this to me? I said oat milk. You put 2%. What are you thinking? I specifically told you this, right? Somebody just got into a fender bender over here. They're all upset. Somebody just got promoted at their job. They're jumping up and down. They're calling their significant other, telling them the exciting news, right? This is going on. That's going on. All these emotions, all these short-term things going on in people's lives that are affecting them positively, negatively, all those sorts of things, right? As an investor in the market, you have all these short-term things that are going on all the time, right? Imagine you're overlooking the whole universe. You think even to a higher level. So in the market, you have all these billion little short-term things going on, right? It's up for you to zoom out, take a much bigger view of things, and by taking a much bigger view of things, you don't get caught up in all the short-term stuff going on, right? Because if you just looked at short-term stuff going on, you could view the earth as it's bad, it's good, it's whatever at that particular time, right? Some country just shot a missile at some other country. Oh my gosh, right? You got to take a bigger view. And so the way I look at it is I'm overlooking this whole thing. And so I'm not getting caught up into the short-term thing that's going on out there at that particular time. I'm overlooking this whole project. To give you another example of kind of how this works, right? Remember when I got hired at Quick Trip back in 2010 to be an overnight assistant manager? And picture it's 4:30 in the morning. My manager comes in at 5. I want to make sure the store is looking just perfect, because that manager, I need to impress him, so hopefully I get promoted to the next position, right? So I'm running around, trying to make sure the coffees are ready and the teas are ready and every little part of the store looks perfect and the counters are all perfect, right? And all this, and I'm running around, boom, 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 and I'm doing all this, right? And imagine the CEO of this company that has hundreds of stores. He's not worried about, are the teas ready or the coffees ready in the morning? He's got, he's overlooking the whole organization. Like, that's what somebody like myself is worried about, that, right? And the store manager's worried about, I'm doing my job right. And then their manager's worried about them, right? And their manager's worried about them. And the CEO, he's overlooking the whole project. He's overlooking the whole company, right? He's thinking like on the highest level you can possibly think. And that's how we need to think as long-term investors. And that's the magic of being a long-term investor. You're not getting caught up into all the short-term crap that's going on out there. When I overlook my public account and all my private portfolios, I'm taking this view from like way up there, right? I'm not worried about what happened here, what happened there, what country's mad at this country, what the new tariff rate of blah, blah, blah is going to be. That's all stuff that's here today, gone tomorrow. I need to focus that my companies overall are headed in the right direction, that I need them headed in, right? Or they headed in the wrong direction, then I have to move out of that stock, right? But I'm overlooking that whole project. And so when you guys hear about something happen in the stock market short term, how should your brain process this? Let me explain to you exactly how my brain processes it. I think this is entertaining. That's about it. It's very entertaining. It doesn't mean anything. If Trump comes out tomorrow and posts something on Truth Social, blah, blah, cool. I'll look at it. It's entertaining, but it means nothing for the long term. If this happens, if this president's elected, that president's elected, if this senator's elected, this one's out, whatever. Like, here today, gone tomorrow. I'm thinking way bigger than that. Way bigger than that. I'm not getting caught up in all the short-term crap that's going on. If a company, missed by 1 cent or beat by 1 cent, who cares? It's just irrelevant as a long-term investor. That allows me to then take a much less stressful approach in the market. I don't get stressed about the market. I know a lot of people are stressing all the time about getting in this stock, getting out of that stock. Oh my gosh, stress. This is just fun for me. I'm just overlooking my companies, making decisions. I understand if I sell a stock for a loss, you know what it was? It's the cost of doing business. It's the cost of doing business. Sometimes you're going to make a mistake in the market. You're going to hold a stock over time. You're going to realize it wasn't the one, and you're going to sell it, and you're going to take a loss. Cost of doing business. That's just how it is. Sometimes you're going to sell a stock early. It's going to go up more. Cost of doing business. I don't stress over it. What am I stressing over? There's a million opportunities out there. Are you kidding me? You think this is the only opportunity? There's all these opportunities all over the stock market. There's always companies going public. There's a million opportunities. I don't need to get caught up in that. You got to think with more an abundance mindset. It's like, going on a date with a girl and it doesn't work out, and then you're, oh my gosh, it's the end of the world. And I'm like, dude, you know how many more women are in your city that you have an opportunity with? What are we thinking about here? Abundance. Don't get caught up into that trap of focus on the short term and scarcity and all this stuff. Think bigger than that. You gotta think bigger than that. And it doesn't matter how much money you have. I don't care if you got $5,000 net worth, $50,000 net worth, $500,000 net worth, $5 million, $50 million, doesn't matter. You got to think the same way. You got to think bigger than that, right? And the more money you have, actually, the more important it is to think like that, right? But even when you're in little money stage, you got to think like that as well, because you're prepping to what? You're prepping to have big money someday. What are we playing this game for? I still think about myself as I don't have much money. I still think of myself like that. It doesn't matter if the public count says 5 million, 10 million. I'm like, oh, geez, that's actually small money. Wait till you see where we're going to be at in the future. That's the way I view it. And so, but I want to stay in good habits all the time. Good habits are hard to break. Bad habits are hard to break. And so you want to get in the good habit of thinking higher level on these subjects, right? And so that's how I think as a long-term investor. That's how you want to think. Avoid the stress. Avoid the, I need to get in, get out, all this stuff. Oh, the market might go down, so I got to get out of stocks. Oh, I got to get back in stocks. It's a lost cause, right? And I would tell you guys, if you see that sort of activity, people talking like that, talk them off their bridge. You might not be able to, but try. Explain to them a little bit, like, think a little bigger here. Like, what are you doing? You getting caught up in all the short-term stuff? We just saw it this year in 2025, did we not? Yes, we did. What did we see? We saw panic in March and April. I remember receiving comments on YouTube right here. Do you know what they said? I just sold everything. Trump's gone crazy. We're going down huge. I could give you a list to the roof and down on stocks that have appreciated 50, 100, 200% since those lows back in April when everybody was selling out, right? Crazy. And so you get these time periods when people just get so caught up in the short term of who said what, who did what happened. And it's like, dude, you got to think bigger than this. You've got to think bigger than this. My gosh. Like we got to be above that. We got to be above that, okay? That's why we do what we do. Long-term investing all the way. Don't get caught up in all the short-term crap. It's no bueno, okay? Hope that makes sense. I might be preaching the choir, okay? Alrighty, next up here. What you must do now before 2025 is over. All right, so sometimes you could buy into a stock. It's not going the way you thought, and you're hoping it goes right in the future. Hope is not a strategy in the stock market you can ever do. In the stock market, you need to be confident that your company is making the right decisions, headed in the right direction. If you are not, you must cut it. You must move on. If I'm unconfident in a company's trajectory, where they're headed in future years, I have to cut it and I have to move on. I can't just hope maybe something happens. I can't just hope it works out. No. Same way this guy picking up the trash right now, dumping in his garbage truck. Like, if his little claw stops working, he can't just hope it magically starts to work, right? He better go out and try to fix that thing and make sure it actually works. Same thing in the stock market. You got a stock that's not working and the fundamentals of the company are not going the way you want it, and you don't think they're going to fix it, you got to get rid of it. I will stay invested in a company and go, I'm willing to go down 20, 30. I'm willing to go down 50% on a stock. It means nothing to me. I'm willing to do that. If I'm confident in that company's long-term trajectory and that I'm going to make a lot of money in that stock. If I feel like I just got to hope and I'm not confident, then I got to move on. And so if you're somebody out there, let's say you sold, stocks for profit this year. We have long-term capital gains, which for most of you guys, you'd pay capital gains tax rate of 15, 20%. If you sell for less than a year, right, and you take a gain on a stock, then you're probably paying your tax bracket, which for a lot of you guys, it's probably 20 to, I would say, like 33%, somewhere in there roughly, right? And so if you're in a situation and let's say you sold a stock for $10,000 profit, right? If it's held less than a year and there's another stock you bought in less than the past year, right? And you're basically not confident in it at all, right? And you're like, I made a mistake here. Like, this just isn't the one. You might have to cut it, move that money somewhere else. And then you can offset your tax. So instead of paying $3,000 tax on that $10,000 profit, if you now have $10,000 loss to write against it, right? Now it's just wiped out. You don't have to pay any tax, right? So your capital gains goes to zero, whether that's short term. Now, same thing with the long term. If you've been holding the stock for 2 years and it worked out great, right? And you sold for a big profit this year, $20,000, great. But there's some other stock you bought, 5 years ago, and you've just been hoping and it's not working out. And you're like, I got to cut this and move on. You take a $20,000 loss, boom, you just took your tax down to zero, right? And obviously it doesn't have to be perfect in regards to that. It can always be a certain amount, but that will help lessen your tax blow a certain amount. Now, where people get in a problem with this is they might do a strategy like this even in stocks they believe in. No. You cannot sell a stock you truly believe in and you believe is headed in the right direction. It only works if you're cutting a stock that you do not believe in anymore, that you're at the point in that stage with that stock where you're like, dude, I don't think this is going to happen. I'm just riding on hope now at this point in time. The company's fundamentals aren't going the way I want it. The valuation, like, it's just not good, right? And that helps lessen a tax blow in a certain situation like that. So just something to keep in mind there, because, if you hold a portfolio of 10, 20 stocks, like, there's going to be some that you're probably taking profits on, some you're taking losses on, right? In the public count, I've taken profits of probably close to $700,000 this year. With that being said, I've also taken losses in that portfolio. So the net is I'll have to pay taxes in that portfolio of probably a little over $500,000. And then you can add in my private portfolios as well. So I owe the IRS a lot of money, but I offset it some with some losses. So cost of doing business. Like, sometimes that's going to happen, right? And the ones I moved out of is because I just didn't really believe in them anymore, and that's fine. That is what it is, right? So something to keep in mind there. Is Oracle an opportunity? That stock has been damaged. Is it an opportunity? Well, this is fascinating. In regards to Oracle stock, is actually had, in my opinion, a very bad year. It's only up 10%. Now, this is extremely surprising given it had two unbelievably good pieces of news come out for Oracle this year. Like, if Oracle didn't have great news this year, it'd be like, okay, 10%, whatever. But considering it had such great news, I'm actually shocked by this. One, now they're basically, Oracle stock jumps, so this is actually today, but this has been rumored for like 6 months now, as cloud provider joins investor group to run TikTok's U.S. business. So it's still a little unclear how much Oracle is going to benefit from this, but it seems like they'll likely end up benefiting a lot from this financially, right? TikTok's huge, and so TikTok's big in other countries as well, but it's huge in the United States, especially with a lot of the younger generation. And so the fact that Oracle is now going to be in a situation where they have that U.S. business in some capacity, I'm sure they're going to financially benefit from this. And so I think that's great news for them overall. Then the second piece of great news that happened this year for them was OpenAI announced a massive partnership where OpenAI is committing to over $300 billion to buy computing from Oracle Cloud infrastructure over several years, enabling OpenAI's AI development. I mean, that's insane. Like, that's phenomenal news for them, right? Like, that's game-changing, literally game-changing news for them. So then you look at the stock, only up 10% after those crazy, huge, great piece of news. And you got to say, what gives? So here's the thing. Listen, OpenAI. People have doubts about fulfilling that sort of need, right? OpenAI committed over $300 billion to buy computing from Oracle. Like, that's a big number. And here's why. If you look at ChatGPT, its market share has actually already been decreasing. It's still an insanely high market share, but it is decreasing. And as Google Gemini catches on and some of these other models, we don't know if ChatGPT is actually going to end up being the winner chicken dinner. If they're not, then that puts into question the whole $300 billion plus a spend with Oracle, right? Remember, back in the internet age, everybody used to not use Google. You know what they use? Yahoo search. You know what they use? Ask Jeeves, AJ.com. That's what they use. No one was using Google. Google, obviously, ended up being the huge winner chicken dinner. Yahoo slowly became irrelevant over time, and I don't even know what happened to AJ.com, okay? And so just understand, ChatGPT looks phenomenal position. Maybe they stay in that position. Or maybe their position gets weakened quite a bit, and then they're not able to spend $300 billion plus with Oracle over the coming years, right? Maybe they only spend $100 billion instead of $300 billion, which would still be a big number, but it's a long way from $300 billion. And then maybe Oracle gets overbuilt, and then, pricing collapses. Like, that's a possibility. Maybe OpenAI becomes irrelevant somehow, and, they don't even get a fraction of that $300 billion, right? So there's a wide range of ramifications that can happen there, right? It's like, maybe this happens, they spend $300 billion plus over the next few years. Maybe they don't spend any of that, or maybe it's some amount in between. Maybe it's $200 billion, $100 billion, $50 billion, $75 billion, right? And so, but there's major doubts, and I think those are fair doubts, right? No, you might say, is it the valuation with Oracle a concern? Listen, the valuation is not the problem with Oracle. The valuation with Oracle is actually pretty dang fair. I can make even an argument that if Oracle has very strong growth over the coming years, Oracle's undervalued right now. Valuation is not the issue with Oracle, but something that is issue is right here. Debt levels. So cash to debt ratio, 0.16. You have about 16 cents in cash and marketable securities for every dollar of debt. This was as of their latest quarter. $124 billion in debt on this company. That's between long-term debt, short-term debt, and capital lease obligations. Here's the issue. This company is supposed to go fortunes of debt more. Add to that balance sheet. They're going to likely take on easily tens of billions of dollars of more debt over just the next few years, if not 100 billion plus. For a company that's already going into this situation in not an ideal debt situation, not bueno. And there's also concerns about this is going to be lower margin business. So if you got a lower margin business here, huge debt loads, then it could, if you say, okay, Oracle spends $100 billion, takes out another $100 billion of debt, and next thing you know, Oracle's got $220 billion of debt on that balance sheet. If they're making bank off that, great margins, and you say, oh, they can pay that off. But what if those margins aren't quite there, right? And so it takes them forever and ever to even try to pay down that debt. And that's something you have to factor in when you're making an investment and you're thinking about a stock for the next 5-10 years. You've got to consider, like, how long is it going to take this company to pay back this debt and get this balance sheet in a better position? So these are all things that matter. And so the way I would look at it is Oracle an opportunity or not? If that OpenAI deal actually works out, I think Oracle is an opportunity. I think we'll look back and say Oracle at $100-something was a great buy. They don't even have to do the $300 billion plus in spend. Even if they spent $200 billion, $150, I still say Oracle was worth a buy here. With that being said, if that doesn't even come close, and Oracle has to take out debt at very unfavorable rates, which looks like that could be the situation, then we're not looking good, in regards to the stock. So I look at it as it's a murky, cloudy picture. It's not my cup of tea. And so you don't see me buying Oracle stock right now. I'm keeping an eye on the developing situation. Maybe I end up grabbing some shares eventually, but it's just, there's too many other opportunities. That's the thing. There's thousands of stocks in the stock market. There's too many other opportunities in the market to get caught up on a one that I'm very unsure with. Is that $300 billion going to be spent? I don't know. How much debt's going to have to be taken out? At what interest rate? Those are all very, what are the margins on this business even going to be? That's, I'm a little confused on that, as everybody is, and that's why the stock is only up 10% in the past year, despite two amazing pieces of good news, okay? Next up here, my favorite software stocks for 2026 and beyond, then we'll talk Nike. So, as far as my favorite software stocks, obviously Palantir comes to mind, but Palantir's got a valuation problem going for 2026, right? It doesn't have a business problem. That's the great news for Palantir. Their business is on fire. Going to still be putting up amazing numbers next year, but, in my opinion, the valuation, that's a concern. So, Palantir, I like it, but I don't love it, right? And that's kind of the way I'll put Palantir at this point in time. A few years ago, it was a different situation. 2-3 years ago, I loved that stock. Oh my gosh, couldn't get enough of it. Buying. Now I'm like, Adobe, I really like this one. It beaten down dog, hated stock. No one likes it. No one wants to own it. That's fine. I'll be the one to own it. Give me the whole company. Great buyback on this company. Great earnings per share growth. Very impressive revenue growth still for a company at their stage in the business model. Sticky business model. Adobe, very misunderstood stock. Watch the hatred around Adobe stock fade away over the next year. Just watch it. CRM, Salesforce, another one of my favorite software-related stocks. It's a very sticky business model. They keep everybody in their ecosystem over time. So far, we're up 6% on the stock, but I think that's small potatoes compared to what will be up long term in regards to that one. I think I spoke about Adobe and CRM in a video I did a few weeks ago called 7 Stocks I'm Buying, December 2025 edition. So if you want to hear me talk more in depth about Adobe and about Salesforce, you can certainly check out that video. There's a stock I'm keeping an eye on. It's called ServiceNow. Ticker's on this one now. $155 stock, down 30+% over the past year. I'm keeping an eye on it. I need to dig more in regards to this company. They've had impressive growth rates. They're now doing an acquisition that a lot of people hate. So we'll see what happens with that. So I'm keeping an eye on this one. I'm going to do some more study on ServiceNow. It might be an opportunity. It might not. We'll see. We'll see. You might hear more if you hear more about ServiceNow in the future, I like what I found. If you don't, you'll know I didn't like that one. Okay. So just pay attention to that in early 2026. If you hear about me talking ServiceNow, I liked it. If you don't hear me talking about it, basically it means I looked and I didn't like what I saw, either on the valuation front or the business model front. Okay. Nike, next up here. Okay, so we got to talk about Nike. Oh boy, another hated stock. Second worst stock in the public count on this one, down $52,000. Cost of doing business. Let's say, before we even talk Nike, let's say I sold it for a loss, $52,000, $100,000. Does it bother me? No. Cost of doing business. It's like being in the NFL and take a big hit and be like, the cost of doing business. Like, I don't know what else to tell you. You break your finger, you play in the NFL, cost of doing business. That's just going to happen, right? Like, play a violent game, violent things are going to happen. Like, okay, like that just is what it is. And so in the stock market is a very violent place when it comes to money. And so sometimes it's going to go very, very well. And you're going to be the one inflicting damage out there, right? As you can see with a stock like Meta. Like, look at Meta. And that stock's weakened a lot recently, and we're still sitting on $883,000 of gains. That doesn't even account for a lot of the profits I've taken, right? Palantir, I've taken so many profits on Palantir stock. Oh my gosh. Remember, I used to own 5,555 shares of Palantir not that long ago. I'm down to 1,000 shares. Imagine the amount of profits taken there. So, cost of doing business. If Nike doesn't work out and I have to end up selling that stock for $50,000, $70,000, $100,000 loss, cost of doing business. It is what it is. Like, I don't think that's going to happen. I think Nike's going to do very well. But with that being said, like, that's just how I think about this game. Like, you're never going to bat 100%. There's certain stocks in here I'll end up selling for losses. I don't know what that is. Right? Maybe it's Honest, maybe it's not. Maybe it's Nike, maybe it's not. Maybe it's PayPal, maybe it's not. Right? Maybe it's this Hedge right down here. Who knows? I'm never gonna win every single stock. It's impossible. No one does that. Warren Buffett can't even dream of doing that. Every great investor you ever looked up to, none of them could do that. Bill Ackman, go through the whole list of them if you want to consider him a great investor. As far as Nike here, what's going on? North America, revenue's up 9%. Now, North America seemed to really be the market Elliott Hill wanted to focus on first. So when he came in at the company, it seemed like he really put his foot down. And he's like, that's where we're going first. That's where our focus and our attention is going to be. Why North America? Well, it's their home market. It's also their biggest market. So if you want to talk about where your focus needs to be from day one to get that market right, better be North America. And so he focused, in my opinion, on the right market to get fixed first. Remember, Nike's a huge company, so it's not like you're going to fix all the issues that Donna Ho made, right? You're not going to fix all those issues in like one day. It's like, oh, we fixed it all. We're good now. No. It's a process. And so when it comes to Nike, they've fixed North America. Revenue's up 9%. This early on in the turnaround's pretty shocking to me, just to be quite honest. Europe, Middle East, and Africa. So this was kind of secondary, right? And they got that business in a place where revenue's down 1% year over year. So Europe, Middle East, and Africa looks like it's positioned for 2026 growth. We'll see, but it looks promising as far as what's going on there, right? It looks like that's a little further ahead. Now, the one that's lagging is China. China will be next up after Europe, Middle East, and Africa, in my opinion, but we're talking that's more of a second half 2026 of starting to see great numbers out of China. My guess is the revenue decreases on a year-over-year basis start to look a little less bad, let's call it, over the next 2 quarters, and then maybe 3 or 4 quarters out, we could be talking about that market getting back to growth. No different than now you see North America growing very nice at 9%, right? Asia Pacific and Latin America, that I kind of put in that China category where it's like it was a lagger. It's not the most important business for them, certainly, but they'll get it back on the right track, in my opinion, in the second half of 20. This one might turn in the first half of 26. Keep an eye on it. But China, I feel like, will turn as far as going to positive second half of 26. Asia, Pacific, Latin America, that might be more of a first half. We'll see, maybe potentially second half. So, and then Converse business, Elliott Hill replaced pretty much the whole team that was running that Converse business. I don't know if you guys even knew Nike owns Converse. And so he said, we're going to do a whole reset there with that whole business model in line and everything like that. So the numbers look horrible out of Converse, down 31% year over year, but that's a complete reset to that business model. That just is what it is. So they're resetting that whole business model. That should be ready to get back to growth. I would guess, my guesstimate is likely second half of 2026, once again, in regards to that. So we're already getting proof that they can turn the corner. That's the thing here. We're already getting the proof that they put in the work and they can turn the corner. So why would I doubt? Why would I have doubts about them being able to turn the corner in China, Asia Pacific, and Latin America? I don't. I'm very confident. I don't feel like I have to ride on hope in regards to Nike. They've already shown me they can turn it. They've already shown it. Like, the proof is in the numbers. The proof is in the pudding, as they say, right? So when we start talking about turning Europe business positive, China business positive, Asia Pacific and Latin America positive next year, I have no doubts whatsoever in regards to that. And I believe you'll start to see every market positive. Now you may say, why not wait till that happens to buy the stock? Do you think Nike's going to be $50-something when every market is then positive? Nike, by that time, we could be talking about an $80 to $100 stock. You know, it's like the 50s would be like a forgotten thing. And so in this last move here, it does not surprise me at all in regards to Nike. As far as this last little 10% down here, tax loss, it's a perfect tax loss harvest stock. So if they came out with every market was back to growth and like some miracle happened, which miracles don't happen in business, like very, very, very seldom, right? Then maybe the stock would have traded up, but this is a natural tax loss harvest stock. Everybody that's bought it's down on it. And so, you know, the sell off here at the year end, yeah, that's exactly what I expected. But everything Elliott Hill's doing is short-term pain for long-term gain. Everything he said he was going to get this company pointing in the right direction. I'm very confident he's doing that. I listened to the conference call, great conference call. Yeah, I have no doubts. We'll see how the business can, what I need to see about Nike, like, I need to see those numbers get less bad in terms of the markets that are, you know, not going so well. I need to see North America continue to be a strong market. And then the second half of the year, I need to see these markets that are bad right now start to turn to growth. He does that. You know what's going to happen in the margins of this company? We'll see gross margin acceleration. We'll see earnings per share acceleration, net income acceleration. And so, yeah. And then, you know where the stock's going by that time? Like, oh my gosh. And then, believe it, the thing about Nike, this is a stock that Wall Street's going to love again. This always was a very loved stock by Wall Street, other than the past few years, because the numbers were bad. And so Wall Street had to move out of it. But they're going to come back, just like an ex who's addicted to their ex, okay? They're going to come back. It just is what it is. They're going to come back. As soon as the numbers start going positive, you want proof? Look at Estee Lauder. EL stock, another stock I own, very similar situation with to Nike in terms of a beaten down dog stock. No one cared about it. Wall Street used to love it, then they hated it, right? Stock went from a $370 stock all the way down to a stock that went down to, gosh, at the lows, I think Estee Lauder went down to $50 or $60. And now I believe it's back over 100 plus. That's another perfect example of they starting to show the numbers have turned, right? And now Wall Street's coming flooding right back to that stock. Same exact thing is going to happen to Nike, in my opinion, in 2026. As the year ticks on, Nike numbers get better, stronger, better. Markets bottom, start, and trough, and then start moving up. Boom, they're going to come flooding right back to it. And that's the name of the game, long-term investing. Once again, the private group is closed for the year. If you want to be front of the line for when we do reopen it in 2026, that will be the pinned comment down there. Access to all my course curriculums, private Discord chat, exclusive weekly videos, all that good stuff. First off, we're going to talk about my Tesla hedge. It is not going in the right direction. I want to talk about that, kind of speak about that, share my opinions and perspectives there, and all that good stuff right at the top. From there, we're going to get into Nike. Nike earnings out. Want to share my perspective and opinion on their earnings. Do I think this is a great buy still? Does this earnings change my opinion on this? All those sorts of things. So we'll get into that. Then I want to talk a little bit about Cheesecake Factory in a comment I got on the channel just a couple days ago or so. And I wanted to kind of share a perspective on this, a little higher level subject we'll get into there. Fast money traders react to Nike earnings. Something so frustrating happened in this one. So yeah, I'm looking forward to reacting to that one with you guys. Then I want to react to this one, OpenAI. This one just came out here recently. OpenAI is aiming to raise as much as $100 billion, valuing around $830 billion according to the Wall Street Journal. This is huge. For all the AI stocks, we'll explain why, what's going on there. I'll share my opinion and perspectives there. And lastly, we'll get into my entire 2026 possible buys watch list, and I'll share my opinions there. One thing all I need from you guys real quick before we get rolling here, just please hit that little thumbs up icon, that little thumbs up button. That means the world to me. Everybody that's already done it, thank you so much. Additionally, if you want to be subscribed to the channel, you can certainly subscribe. Two pieces of housekeeping. One is the private stock group is closed right now to new members. If you want to apply to join us when we do open it back up in 2026, you can do so. That will be the pinned comment down there. You will be toward the front of the line for whenever we do open that back up to new members. And the other thing I want to draw to your guys' attention is 3 videos I put out on the main channel recently. This one from 6 days ago, how to scale to $10 million plus net worth. I think you guys will really enjoy that one. That's just a gem dropper there. My predictions for the best stocks in 2026 and overall market performance. And then this one, $64,000 just spent on these stocks today. Alrighty, so we got a lot to go through. Let's start out here. Let's start with the market real quick. Then we'll go Tesla, then we'll go Nike, then we'll just keep rolling down, okay? First off, real quick here, what's my perspective on the market today? Listen, when I look at the market today, you can't get too excited about this and think like the AI movement's back. It was a great day. MU was like the poster child of the success on the day, right? MU moved up huge, and so that pushed up everything. All the AI stocks, those sorts of things, okay? And so my opinion on the market today is it was like, oh, it was a nice little Santa Claus rally type. By the way, we got a gorgeous sunset going out these windows right now. I'm enjoying this. This is gorgeous. Like, anyways, you guys can't see it, but it's gorgeous out there. Trust me. So today, market action, like, a little Santa Claus rally today, but big deal, right? No, Tesla, my ass, so this is a hedge that's not going well. This is a public count, down 25% in this one. It is not going well at all, right? And I also posted this today. My Tesla hedge is holding me back, right? I troll so much on X. You have no clue. Like, if you ever want to follow me on X, by the way, it's linked in the description area down there. But it's so funny, though, because, you know, if you're in the know, like, you know that I'm trolling hard, but some people aren't in the know and they get crazy. So it's very, very entertaining, by the way. If you know, you know. But anyways, you know, in regards to that, it is, in all seriousness, holding back the public count a bit here. You know, that position's gone down 11,000. You can say if I had it in a long position, it'd be doing much better, right? But it's there in case things really go south here on the market. My plan is to hold it for the next 3 to 9 months. We'll see what happens there. I got some of this hedge in other portfolios as well. So I'm fine. It is what it is. If, you know, Tesla just keeps moving up and, you know, $600, $700, it goes $2 trillion, $3 trillion, like, you know, whatever. It is what it is, right? Cost of doing business. That's what it comes down to when you hedge a portfolio like that. Like, it's a cost of doing business. Whenever I do a hedge, I always expect to potentially lose all the money. No different than if you have health insurance, if you have homeowners insurance, if you have car insurance, expect to lose all the money, right? Because you're expecting not to ever use it. And you probably won't use it. If you're a good driver, you know, you probably never have to ever use your car insurance. Like, you could pay into that dang car insurance for 20 years and probably never use it. Same thing with homeowners insurance. The chances your house burns up or burns down, pretty low probability, but you still keep paying that homeowner's insurance month after month after month, right? And you can go through it. If you got great health, you probably aren't even using your health insurance because you probably never even meeting your deductibles, right? So that's the way I look at hedging a portfolio. You could say it's money wasted. I don't really look at it that. I look at it as insurance. No different than I could look at car insurance as a waste of money and homeowners insurance and every other insurance out there. Like, it just is what it is, right? So that kind of covers that. Okay, next up here, Nike. This is a big one here, obviously, in regards to earnings. So for the numbers, revenue was up one. Keep in mind, Nike's going through an entire turnaround their business model. So if people are not familiar with what's going on with the Nike story, they had a guy who was running the business into the ground. They brought in Elliott Hill a year ago. He's now been on the job for about a year. He's had to clear inventory, get the product back right, again, those sorts of things. And we now have 2 straight months with revenue trending up, which is great news. If you want some great news in regards to Nike, we do have revenue trending up again. Now, cost of sales are getting hit, right? So gross profit fell 6% year over year to $5 billion from almost $5.4 billion the previous year, right? So gross margin fell. That's likely discounting of old inventory, stale inventory, those sorts of things, and also moving product in China. Their China business, they're doing a whole reset of their China business right now. North America looks way ahead of schedule, but they really focused on North America first, and Elliott Hill's turnaround here. China is really second. So China, you're going to see China turn around in a major way, in my opinion, throughout 2026. Just keep that in mind, okay? Demand creation expense, That was up 13% year over year for the company. That's the lifeblood of the company, though. That's like R&D for a tech company. Demand creation expense is very, very vital for Nike. As far as their overhead expense, they did bring that down 4%, so that was good to see on a year-over-year basis. And total selling and general administrative expenses was only up 1%. So as far as a percent of revenues, 32.5% from 32.4%, so not much of a raise there, right? Income before income taxes, right around $1 billion. Net income was just under 800 mil, down 32% year over year. And diluted EPS, 53 cents. That was down about 32% year over year. These numbers did beat Wall Street's expectations in regards to revenue and earnings per share, and by quite a large margin, especially in regards to EPS. So since they're beating Wall Street expectations, how I would frame this is they're ahead on their turnaround, essentially. If they were missing Wall Street estimates, they'd basically show you that they're behind on their turnaround. Nike's ahead of their turnaround, so that's good news overall. That's what we want to see. We don't want to see Nike be behind. We want to see Nike be ahead in regards to this matter. So my perspective on Nike overall here, I posted this inside the private group. I said, bad news is numbers are still rough. Good news is they have 2 straight quarters with revenue up. More good news is they are beating expectations, so it means the turn is ahead of schedule and not behind. Last good news is during this horrible turnaround time for Nike, they just pulled in $792 million in net income in a 3-month span. Pretty darn impressive. And yeah, that's the special thing about Nike. They could be going through this horrible turnaround. They're resetting all their markets and all this stuff and resetting inventory, and $792 million of net income. Like almost any other company on the planet would cherry places with them. It's a one of one. And so me as a long-term investor, this earnings gave me even more confidence that I want to invest heavier into Nike and continue to. I think 2025 has been the magical year to invest in Nike. And I think we'll see that as the years tick on, 2026, 2027, 2028. Such a great long-term investor name. And everything's looking exactly how I want it to look. It looks like the China business will likely turn in 26 to positive. You already got North America trending very nicely to the positive upside. So if we talk about North America continues to build, and then we get China to trough in the next 1 to 2 quarters, and then that business starts growing, do you know what's going to happen to revenue? And then do you know what's going to happen to profitability? Because when you start all of a sudden having revenues go up 3%, 5%, 7% on a year-over-year basis, right? And then you're not having to discount inventory anymore, your cost of sales drop while revenue is going up, your gross profit explodes to the upside, and all of a sudden you're bringing in $6, $7, $8 billion of gross profit, right? Meanwhile, you're keeping your expenses low here. In demand creation expense, I think they'll probably, I don't want to say flatline it, but close to flatlining over the next year or two. So what you'll see is their gross margin will increase dramatically over the next, we can call it year. Let's just call it between now and this time next year. Their gross margin will explode to the upside, in my opinion. Their net margin will explode to the upside, and their revenue will look like a strong single-digit revenue growth. Maybe double-digit growth, but I don't want to go that far. I think strong single-digit revenue growth. So everything's right on pace. Yeah, for me as a long-term investor, I'm not even sweating. Whatever Nike stock wants to do over the next 2 weeks is fine with me. I'd love to buy more shares. Only people that may be sweating are people that have call options, put options on Nike, might be margin out, something like that. Short-term traders, those sorts of people. Nike's not really a stock you want to short. I mean, you don't want to short-term trade anything. It's just gambling, right? But especially not Nike. That's one you're either long or you're not. You're either long it or you're not it, right? So that's just something to kind of keep in mind here. Alrighty, next up here, let's talk a little Cheesecake, because I think it's an important comment out there. It says, I love cake because I sold it last week for $50K in losses to offset some AMD gains. Cake sucks. Food sucks. Is stale. Antique restaurant model. North Italian flower child couldn't save it in this market, right? And so that is a good example of wow, they're not very good at the stock market, are they, right? Look at the 1 week on Cheesecake. This was the 1 week before. The 1 week on Cheesecake now is, this is a 1 month. 1 week on Cheesecake is 5% up, right? That's on a 1 week. If we go to a 1 month, here it was 13%. This was posted yesterday. Now Cheesecake on a 1 month is up 16% on a 1 month. Okay. What about a 1 year? So on a 1 year, the stock is, it was flat here yesterday. Now it's slightly up. And keep in mind, these do not count all the dividends you received. On a 2-year, cake's up like 50%, and on a 3-year, cake's up, we can call it right around 60% now, roughly, right? So, and that doesn't include all the dividends, so I was just like, where'd they buy? Like the very peak? And that almost smells like somebody that was probably trying to trade it for momentum, right? And thought like they were going to try to trade it around or something like that. This is how people screw themselves in the market so bad, right? Like you could just play this game so simple. I play this game so simple. Great companies, I buy them. They go down. As long as the valuation's appropriate, I buy more shares. Everybody's stressing, man. They're stressing so bad. And another thing I get is, oh, Jeremy, it's so easy for you. You're so rich. You're filthy rich, Jeremy. Oh, you got so much money. It's easy for you not to care. F you. F you. I was more broke than you ever were. I was more broke than you ever were. Go take a hike. Go take a hike. Give me a break. You got to be joking me. I was the same mentality when I had $1,000 to my name, $500 to my name, $500,000 to my name, $5 million to my name. It's the same thing. Same mentality I always had. You either got a winning mentality, you got a losing mentality. You either understand how to play this game on a high level or you don't. And you might not. You might get it eventually. It might hit you or it might not. Right? I'm thankful. It hit me very early on. Like back in like 08, 09, like I just got it. I'm like, oh, okay. I had so much more to learn about the market mechanics. I had so much more to learn about companies, valuations, how to properly value stocks. Like that was years and years and years of education I had myself. But I got the core principle right from the go. And that's one of those things like you either get it or you don't. And it has nothing to do with really like your intelligence level. It doesn't really have anything to do with your IQ. Like, you could have the highest IQ in the world and still be complete spaz in regards to stocks and just I'm in, I'm out, oh my gosh, I'm down in the stock, I'm selling, like holy smokes, right? You either got it or you don't. I'm thankful I had it. And then I learned the game from there. But that core principle, if you don't have that, it's going to be brutal. It's going to be a long market for you. It's going to be a long market for you. And it's not going to be good. It's not going to be good. And so you just got to understand to play this game for a long-term like game, right? We're playing these stocks for years. We're not in and out. Like that's clown stuff. If people want to gamble money in the market, go gamble. Come to my city, come to Vegas, come pay my taxes, right? Like that's why I don't have to pay state income tax. It's beautiful. Come on, gamble over here. You probably got the same odds you're going to win or lose on the strip as you do gambling in the stock market, right? Or play this game on a highly educated level. And let's actually run valuations. Let's run projections. Let's actually do this game the right way, right? Let's invest in stocks for the long term. It's up to you. It's up to you, right? And at the end of the day, if somebody's doesn't want to own one of my stocks, it makes no difference to me. You don't move the market. I don't care how much money you have. You don't move the market. I don't move the market. Look at how much money I have. I don't move the market. So if somebody doesn't want to invest in one of my companies, no sweat off my back. What does bother me, though, is when people are just gambling and they're taking losses on stocks, and it's like, dude, like, what are you doing? What are you doing? Like, you're just gambling money out there, buying at all-time highs, and then, selling when the stock goes down, and just like clown behavior. It's really clown behavior. You got to look at yourself in the mirror sometimes and be like, what am I doing? Like, it's crazy. Like, to me, it's crazy. I just look at people, I'm just like, what are you doing? Wild. Is it not wild? Like, oh my gosh. Insane, man. Insane. And for, other people that are watching this that, you get it, right? You understand the long-term game. Like you're with me. You're looking at these people like, what are they doing, man? It's freaking clown activity. And all we can do is just sit back and laugh. It's just hilarious. Went to Flower Child here today in Henderson. Had lunch and it was absolutely packed, as you would expect. Only complaint I have about Flower Child is I wish I didn't put the register so close to the door, because it gets so busy. Next thing you know, you have to wait outside basically to even get in line. So anyways, crazy, man. Wow. All right, let's react. By the way, and the crazy part is, I wish it was only like retail folks who do some silly stuff or say some silly stuff, but gosh, some of these Wall Streeters are even worse, and we're about to get into one of them.
Stock exchange on Nike tonight. Tim, are we in the middle of the turnaround here? Do you see enough proof? Are you convinced?
I think we are. I think if you're building a position in Nike, this is a place to add. There was nothing I heard today that made me concerned about some of the legacy problems. The positives are 2 consecutive quarters of revenue growth, North America up 8.8%. It's actually a second derivative margin improvement. They're still down, but they're improving. And I think this is part of the story. I think working through the inventory problems are important. The biggest issue with Nike right now is it's not cheap. It's 25 times with peers that are probably 15 to 18 times.
In all due respect, though, Tim, they're 25 times, and guess what? They're during a turnaround phase. This is their bad numbers. The numbers we're getting, this is like their bad numbers, right? Like, this is the turnaround phase. So what's going to happen with their profitability likely between now and this time next year is it's going to increase rapidly. So that 25 multiple is going to go down and shrink rapidly. Okay? So that's an important thing you got to understand about this. And that's why people are willing to pay a 25 multiple or whatever, because they're very of the understanding, like all it is a little bit of math here. All it is a little bit of math.
And at a time when I think people are a little bit concerned about their segment. So if you're building a long-term Nike position, you're buying this weakness. These numbers were fine.
100%, Tim.
You got to look
100%.
at that margin compression, though, down 300 basis points. I mean, that's not anything, right? And if you think about one of the reasons or two of the reasons, it's obviously tariffs and it's also discounting. And, just take a flash of what's going on right now. I mean, that's not a great place to be, especially if you're not concerned. Well, if you are concerned about a consumer and you're not sure about how long this tariff pressure, and then direct to consumer, I mean, down 9%. That's not great. I mean, this is a company that actually has had a bunch of iterations where they've tried to do this. I know wholesale was up, but the direct to consumer I'm looking at was down 9% year over year.
You guys haven't even studied Nike. This has all been laid out. This has all been laid out in regards to DTC and, some of the cutback there. And it's just crazy, man. Like, if you're on the conference calls and things like that, you're educated on this. I really wonder, what do people do with their time? I really do wonder that, right? Like, I'm like, what do people do with their time? Like, you could easily listen to a Nike conference call and already been aware of everything they laid out here, the China weakness, DTC, this all been laid out in the last conference call. What do people do all day? They go to work, right? If they're a Wall Streeter, they work maybe 40 hours a week. And I don't even know if that's real work because half the time they're just jabbing. I'm trying to figure that out sometimes. And yet I see all these people using TikTok and Instagram all day, and watching Netflix all day. And then they act like they're so busy. Oh, I'm so busy. Baloney. You ain't got nothing going on.
I think the win now doesn't really have a real
I worked 3 jobs back in the day. 3 jobs simultaneously.
I think they need the Lulu moment where they have another new CEO. This CEO has been there forever. How long?
Oh, this guy disgusts me. Oh, he disgusts me. I never heard this man. I think I've been watching this show for so many years. I don't think I've ever heard him make one good point ever. That's hard to do. Not even one good point in the whole time I've ever watched this show.
New CEO. This CEO has been there forever. How long has he been there?
A year.
Elliot Hill?
Yeah.
No, he's been here forever, but how long has he been with Nike for?
At Nike prior to being CEO. Okay.
Yeah. So you had Donahoe, who was there for 10 years or so, maybe a little bit less.
No, Donahoe was Mr. What did he work for? ServiceNow or whoever? Before that, he was Mr. Consultant. No. Do not act like Donahoe was a Nike guy. He was never a Nike guy. He was a guy that tricked the board of directors like Steve Scully did back John Scully did back in the Apple days when they kicked Steve Jobs out and they brought in Mr. PepsiCo to run the place. John Scully, right? That's what Donahoe did over there at Nike. He tricked them, right? And a lot of you guys probably don't even know what I'm talking about right now. But anyways, look it up sometime.
Then you have Elliot Hill, who they dragged sort of back in. I think you need new blood. I think you need to have that moment where we need an epiphany. We need something that's going to happen that changes.
The whole business is doing exactly what they're ahead of schedule. Are you kidding me? Like, the turnaround's going perfect. It's ahead of schedule. They just beat revenue. They just beat earnings per share substantially. Everything they laid out as far as DTC cutback, the China weakness, the resets, inventory, wind down in different markets and discounting, this has all been laid out. Are you kidding me? Elliott Hill's doing exactly what he said he was going
whole
to do.
speed.
This is perfect.
You're not getting it with a legacy person inside Nike. And you have Hoka taking share. You have On taking share.
Gosh.
They're not taking share in the NFL. They're not taking share in pro sports, but they're taking share walking around the streets. Too many private competitors. I think you could have...
Oh my gosh. The same thing they said for 40 plus years now. Oh, this company, that company, this company, that company. And then these companies fall off. They fall off just like that. I mean, heck, we're already starting to see it happen with Lulu. People thought Lulu was one that would be invincible. And now Lulu's all of a sudden, like, starting to fall off, right? Dude, come on. Falling into the same trap as people fell into decade after decade after decade in regards to Nike is crazy.
Then, where it can rally off the bottom, China is still slipping.
Cheers.
North America may be stabilizing, but not out of the woods yet.
It is a very large company, and if you want to get anything new, you don't just 3D print it and put it on the market. I mean, there is a pipeline process, and we are seeing some green shoots. Sarah mentioned the Vomero 18, which is very shown well, and that is part of the innovation that Elliott Hill has promised. There's also the Pegasus line that apparently is doing well, too. So, I mean, there are signs that there is innovation, which is what Nike really needed.
Right. So I'm not concerned. To Dan's point, I disagree a little. I disagree with Dan on a lot, but just right here on this minor point of DTC, this is a concerted effort. Change the mix of DTC.
I like Karen. I do like her.
To wholesale. However, though, Nike, the call just started at 5. They have had calls that are eventful. Sure. So it is absolutely worth listening. They've dropped some bombs and some good things. So we kind of got to wait to see what they say.
Oh, man. Okay, next one up here. Now, this matters significantly for AMD, Oracle, NVIDIA, ton of stocks.
About with regard to the AI train and how fast it's moving. Well, the Wall Street Journal reporting now that OpenAI is in the early stages of a fundraising round that could raise as much as $100 billion. At least that's their target at this point in time. And in this fundraising round, which is at its early stages, they say it could value the company at as much as $830 billion. This is according to people familiar with the matter. And the information also earlier reported some details of OpenAI's latest funding efforts. But of course, this would be a key test as to how much capital is still out there to fund this AI build out and at what price if it ultimately comes to pass. But OpenAI seeking a new fundraising round that could value it as high as $830 billion. Melissa?
Okay, seeking is the key word here then.
I'm
not
seeking too.
Right. I'd love to seek $100 billion for an $830 billion valuation also, but it may not happen. Leslie, thank you. Leslie Picker.
Was it 750 yesterday?
I thought I had read 750. I mean,
I thought that I read that yesterday.
Yeah.
It's interesting. I mean, they need cash. That's not surprising, right? But it's interesting with it's such a black box from the outside, right? Nobody knows what's going on in OpenAI. And yet there are so many players that are a party to some sort of agreement with them. I would think there would be more clarity, more transparency, or a leak or something about the underlying financials there than there seems to be.
There's no incentive for them to leak anything.
When you're raising the money,
you're tied to the success of the company. I mean, if the implication is that a leak would disclose,
we don't know, it could
things that may not be as great as everybody thinks.
Possibly, right? There would be some concern about that, and yet they still are able to. I don't know. I can't imagine how busy Sarah Fryer is. This is an extraordinary job as CFO.
When was the Code Red announcement?
2 weeks ago.
Was that only
isn't when you hear Code Red,
it doesn't go up in value?
How did we go from $500 billion to $800 billion since the last time
they
raised money?
The first raise this year was $150 billion. Then there was $300 billion. There was $500 billion just a month ago.
Five was the last one.
And that was when. How do you feel like if you're an insider, you're an employee, and you sold $6.5 billion at 500, and now they're what's that?
Well, it depends on what your
not
cost
if you just
is.
sold your stock.
Well, you always should
insiders sold stock at $500 billion.
I understand.
A month ago.
What is your
They
basis,
should be pretty happy,
right?
I
should be pretty
exactly.
happy.
I think
yes.
they're.
If OpenAI were a publicly traded company, would it continue on a steady drumbeat higher amidst all of the skepticism about the AI trend?
Look,
it would not.
The public markets
It's
have
completely
already told you
now.
what the view is on AI in the last month.
Right.
It's so in a world where there's no liquidity, the mark to market's very different in private. And that, by the way, it saves a lot of people from themselves in private equity. It's one of the reasons why it is an asset allocation that makes a lot of sense for people. But I think we're all saying the same thing. I mean, this is hard to believe 2 weeks after Code Red.
Compare the two, right? So we have SpaceX, we have OpenAI, and there's not an infinite amount of money to be raised here. So if you look at, I find it interesting, you look at the valuation on both of them, they're both chasing the same dollars, and they both have to have that latest headline that's out to sort of gain the market's attention, because the market only pays attention to the last headline that they say.
Well, if they don't raise the money, it could be lights out for a while here. They have $1.4 trillion in basically contracts out there. $100 billion, that's not going to be easy to do, up from, again, $50 billion a year ago to $800 billion. And I'll just say this, the information I had a story yesterday that Amazon is considering a $10 billion investment in OpenAI, and then they're going to get a $38 billion contract for AWS, and then they're going to start, OpenAI is going to start using their Trainium chips.
Sounds like they only need 90 billion more.
Well, what I'm saying is, it's like, this is another circular trade. And you know who's a big investor in OpenAI? It's NVIDIA. And so NVIDIA, now, I mean, it's insane. And so, again, Sam Altman, we're all rooting for you here, because if this doesn't work out, it's going to be a really difficult 2026.
So where's the good news? Where's the bad news? And we'll get into the stock. So I'm looking to buy in 26, as of right now, at least. So here's where it matters significantly for the different players: AMD, NVIDIA, Amazon, Google, all these sorts of companies, right? Listen, if they can raise 70 billion here, 100 billion, whatever amount they're able to do, let's hope it's 100 billion, right? I think it's very good news for companies like AMD, who haven't even, really prospered yet in regards to that. I think it's great news for somebody like Amazon, right? Who could potentially get this contract and those sorts of things and be using some of their custom chips with OpenAI. So I think that's another beneficiary. I think it's good news for Microsoft overall as well. NVIDIA, I don't want to say they're the odd man out, but they I don't think benefit at all from this, because OpenAI is already has their orders in with NVIDIA, right? So that is what that is. I look at it from there's upside from the other players that, they haven't done a lot of business with. OpenAI is doing tons of business with NVIDIA for all their chips. So with this $70 billion or $100 billion raise, it gives you a little more comfort if you're an NVIDIA shareholder, but I don't think there's really necessarily upside there in terms of we're going to get a ton more new orders from this $100 billion they raise. AMD, that's a different story. Amazon, that's a different story, right? It's going to be interesting to see how OpenAI's valuation transforms throughout 26 and 27, given that there's serious competition in the market for these products. Google Gemini is obviously a serious competitor with Grok in what they're doing there at X. I just don't know if they have the right branding there to really have that take off, but I've been pretty impressed with that product overall. I've been really impressed with Google Gemini as well. So we'll see how it all shakes out. But the moral of the story is here, if they could raise that money, here's the thing. If you want to talk about the AI trade getting its mojo back, have OpenAI raise this $100 billion successfully, right? Additionally, you just had the MU, great numbers, great conference call, that adds some fuel to fire, and then have Oracle be able to calm down these fears in regards to CDSs of them. Boom, there you go. You got the AI movement back going again. Okay, so if you can do those three things, then we're really talking. And obviously, MU already came through, so we got one of those three out of the way. Alrighty, so looking at my possible buys watch list here, Kava is still on it. Its stock was up actually significantly today, 5.5%. But that one is still on my possible buys watch list here. It's been a rough stock over the past year, down 52%. Cake is one on my possible buys watch list. That one remains a buy. It's up about 8% over the past year, roughly. That does not include all the dividends received of this one. Cake's been volatile in terms of, the stock But overall, the trend is pretty darn clear over the past few years. It's up and to the right. And, it's just a very clear stock. The valuation is very attractive on it. We know where they're going to be getting their growth from. It's not the sexiest stock. Like, what they do is hard. They've got to actually open up physical restaurants, hire crews, run them on a high level like they do. And, obviously they're very successful doing that, but it's a tough business, but it also creates a pretty strong moat around the business. It's just like what they're doing with North Italia and Flower Child. There's no one else doing that in the United States of America. There's no one else that's building, let's call it a mid to a little above mid-tier Italian restaurant across the United States right now. No one else is doing that. They're the only ones. No one else is building a concept right now like Flower Child. There's nothing like that exists out there that's being, swept across the United States of America right now. So what they're doing on several fronts is very impressive. And then they got their ATM machine, which is obviously Cheesecake Factory. It's an absolute ATM machine there. So Estee Lauder EL, that one's a very strong turnaround here, up 44% over the past year. That does not include any dividends received from that one. EL is very similar to Nike. Only difference is EL's a little ahead of Nike in regards to their turnaround. That stock started to falter before Nike really started to falter. So they're just a little ahead in regards to their turnaround here. And and so that type of momentum we see in EL, I wouldn't be surprised at all if we see that sort of momentum in Nike over the next year. Amazon stock, a lot of fears about depreciation, all these chips they're buying, things like that. I don't worry about that in regards to Amazon. They've always had big depreciation. Meta stock's a significant buy right now, in my personal opinion. Stock hasn't really done anything over the past year, up 11%. Amazon and Meta haven't done a thing. And that makes me feel great about the public count. Because I look at the public count today, right? I'm looking at the public count. $3.7 million plus dollars, right? Back in April, it was down to 2.4. I'm looking at the portfolio, 3.7. I'm looking at an AMD that, in my opinion, still has 1 to 2 more big runs in it. Meta is a stock I think is going to 1,000 plus long term. Amazon I think is a double up plus from here. If we think about Nike, I'm down on that position right now. What happens when Nike goes positive? Then it goes positive double digit percentage. Then we start building from there. We haven't even gotten to that fun yet. So, Elf is a stock that's still $80 or under $80. So there's a lot of positions I have in the public count that I'm looking and I'm like, yeah, we're 3.7 mil right now, but I could see us how we get to 5 and it's not a stretch. I'm like, dang, we could go from 3.7 to 5 in a quick amount of time. Have Amazon and Meta all of a sudden get their mojo back along with AMD. Big Tech has a nice run for a bit, for a 6-month, 9-month span. Next thing you know, public count, you see it $5 million. So yeah, very happy with those. Celsius is one that's been a good stock over the past year, up 53%. If you bought right here at all-time highs, which I'm sure somebody did that, like, oh my gosh, Celsius has a momentum. I'm going all in at 65. Okay, do what you want. Don't buy over a period of time, like every great investor ever will tell you. But do what you want to do. Just go all in one day. Oh my gosh. But Celsius clearly headed in the right direction. That was a turnaround, and man, that turnaround's going very well. I'm so excited to see where their margin profile goes as 2026 rolls along. So excited to see where their revenue growth goes and their profit growth goes as 26 rolls along. Very exciting. RH. So that stock's been a brutal one, down 56%. I'm keeping an eye on RH, not making a move yet. Am keeping an eye. Same thing with Whirlpool. I do expect housing to unfreeze, and we can call it thaw out a bit in 2026. And I think that's going to be bullish for stocks like RH and Whirlpool. I don't expect it to be a hot real estate market in 26. Let me be very crystal clear about that. But I do expect the market to thaw and get in a position where it starts to heat up in 27. And then by the time you get to 28, we have a hot real estate market again. That's my opinion. It might not happen. This is my opinion. Adobe. So Adobe, this is one I absolutely love, trying to buy as many shares as possible. Very hated stock. I think people will be wrong there. Same thing with Honest. American Express, great company. Stock's up 30% over the past year. That's one that is just an easy own, man. Easy own. Nike, we spoke about that one extensively. The turnaround's right on track. CRM, it's been a tough stock over the past year, down 23%, kind of like an Adobe situation. A lot of momentum here recently. You see that stock bottom just a few weeks ago at 225. Now it's 257. And when it comes to CRM, like it's just an easy own. Like some of these stocks, just I don't have to stress about them. Like buying CRM, in these sorts of prices in the 200s, I don't have to stress over. It's just easy, man. Easy owns, easy money makers over the next few years. Like, just give me it. Bath and Body Works, this is one that's still on my radar. Not buying it yet, but keeping an eye. It's lost about half of its value over the past year. It has bounced hard, though. That's the one thing that's frustrating to me. A few weeks ago, it was 14. It bounced heavy all the way up to 19 there. So keeping an eye. Fubo's just a dog in terms of its performance. But it is up 87% over the past year. I don't think once people have more clarity around the numbers, which by this time next year, they'll certainly have clarity around the numbers. I think people will be able to wrap their heads around it. PayPal, I love this one, especially around these prices, 59. Like, come on, man. Elf, love this one, 77. Planning on keeping an eye on. We'll see what happens with the government. The government's a big screw up. We know that. So that is what it is. Elf's had obviously a tough year in regards to stock price. Numbers haven't been the best. I expect both to turn around massively in 2026. This year was plagued by an acquisition that caused the numbers to be all messy here in the short term. So people are like, what's the reality of the numbers? You'll get more clarity between now and this time next year. Additionally, the stock's kind of down and out right now, right? Tax loss harvesting, all that stuff it's gone through. And then tariffs, right? They got hit with slammed with tariffs this year. It just is what it is. So Elf, I absolutely love that stock. And I think you'll see the numbers turn and the stock turn in 26. And that one remains a buy. Like that one I could probably buy all of 26, but we'll see what happens there. Once again, pin comment down there. My private group is closed right now. When we open it back up at 2026, if you want to apply to join us in there, that will be pinned comment, access to all my course curriculums, private Discord chat, exclusive weekly videos, all that good stuff. And you could be at the front of the line. And then additionally, if you haven't got to see these videos on the main channel, Financial Education, make sure you check them out. How to scale to a $10 million plus net worth, my predictions for best stocks in 2026 in overall market performance, and $64,000 is spent on these stocks today. PayPal, applying to be a bank. They want to be a bank. That's an important subject. We'll speak about that, my opinion, perspective on that. Is this a good thing, bad thing for PayPal moving forward? How does this relate to SoFi specifically? We'll talk about that in this video and why it matters significantly for SoFi. Micron earnings just came out in the last couple hours here. It matters significantly to the AI trade. It matters significantly to AMD, NVIDIA, stocks like that. We'll talk about some very important things I found here. Oracle stock cannot stop crashing. This stock is down 40+% just in the past 2 months. It's insane. We'll talk about Oracle, what's going on here, my opinions and perspectives there. Then I want to react to a few videos. If the Fed eases further, S&P could pass 8,000 in 2026. Coming out of here, JP Morgan. That's a big statement. I'm looking forward to reacting to that one. Then we've got to react to everybody's favorite bull, Tom Lee, on his opinion on AI stocks, NVIDIA, the market in general, all that good stuff. Market in 2026. Looking forward to reacting to that one. And then I want to react to the fast money traders here in the last couple hours and their opinions and perspectives on this whole situation with Oracle and the AI stocks, the damage there, and all that good stuff. I appreciate y'all for joining me. One thing only I need from you. If you could just hit that little thumbs up button for me, that would mean the world. Everybody that's already done that, thank you. Make sure you're subscribed here to the channel. I appreciate each and every one of you. Like I said, you guys got to watch these videos as soon as they come out on this channel because YouTube AI is out of control and they won't give me any reason why it'll just like pull videos randomly from this channel essentially. But it's a widespread thing in regards to YouTube. I try to press them on this. The moral of the story is they won't give you any details. And the reason being is they know their AI is out of control. They know it's screwing up left and right, and they don't want to tell anybody about it. And so they just cover their bases by just, they don't give you any like specific reason. It's just, it's a crazy situation. So anyways, folks. Okay. So a bunch to go through here. By the way, pin comment down there. My private group is closed right now. We'll open it back up at 2026. Demand was insane. So we've closed it now. But if you want to apply to join us in there when we do reopen it at some point in 2026, that will be the pinned comment down there, access to all my course curriculums, Discord chat, exclusive weekly videos, all that good stuff. Okay. Alrighty. So PayPal right off the bat here. Alrighty. So listen, in regards to PayPal, they just filed to become a real bank. This is a very important step for PayPal. It looked like they were kind of moving in this direction over the past few years. It's just they finally did it. Okay. The payment giant is seeking approval to launch PayPal Bank, which should offer business loans, savings accounts, and FDIC insurance. PayPal wants to cut out the middleman and become a bank itself. The payments company announced its submitted application to Utah regulators and the FDIC to establish what will be called PayPal Bank. If approved, PayPal Bank would offer small business loans, interest-bearing savings accounts to customers, and FDIC insurance coverage for deposits. The bank would also work directly with Visa and MasterCard to complement its existing payment processing. The former president and CEO of Toyota Financial Savings Bank has been tapped to lead PayPal's new bank here. So, what are my opinions as a shareholder, as somebody that's been buying the stock, all that good stuff, okay? First off, this is a natural extension for PayPal, right? This is a natural extension. A lot of people think about PayPal in Venmo from like the consumer peer-to-peer side, things like that. Maybe you send money to, somebody for lunch or whatever the situation is, right? And that's a component of PayPal's business, and with the Venmo side more specifically. People think about PayPal. Some people use it in terms of, running a transaction. They pay through PayPal. I do that with a few different retailers and stuff like that online. I pay through PayPal. It's just easier. There's their traditional business, but at the end of the day, like PayPal also helps run a lot of small businesses on the back end, and they have a lot of data. And so it makes sense to offer these sorts of banking related products. We know Stripe's kind of nibbled in some of that business as well. I see it as a natural extension. Now, I do not want PayPal to get too asset heavy. They've done a really good job of selling off a lot of their loan business, like a lot of their buy now, pay later, and even them dabbling more and more into buy now, pay later. It seems like they've been wanting to push in this direction, right? Now, I would be really worried and concerned about this if PayPal had a very high P ratio. The reason being is anything banking related always gets trash multiples. Trash multiples meaning like no one's willing to pay up for those companies. So if PayPal had a 30, 40, 50, 60 PE ratio on it right now, like it did years ago, I'd be very concerned, because when I think about a bank, I think about P ratios between 10 and 18. 10 and 18. So we got to look at PayPal's P ratios and see, is this going to be an issue? Well, what do we find? PayPal has a trailing 12-month PE of 12, forward P of 11, 2-year forward P 10. This is not an issue. JP Morgan, I pulled it up here to compare here. JP Morgan actually trades at a much more rich multiple than PayPal. Bank of America trades at a much more rich multiple than PayPal, right? And think about those companies' lack of growth over the years, and then think about PayPal. Like current year expected revenue growth, 5% from PayPal versus 2% for JP Morgan, and Bank of America, surprisingly, 7%. That's kind of shocking in regards to that, right? So PayPal's already valued like a dog bank. Like that's how it's valued. So I'm not concerned at all about this. It's a natural extension for the business model, and gets them into more products and services, gets more people in the ecosystem. How does all this play with SoFi? And why does this matter so significantly with SoFi? Here's the deal. I don't know if you guys follow me on X. I always have it linked in the description area of all my videos, which, by the way, I'm posting all my videos on X now because YouTube AI is tripping. So I'm trying to cover my bases and make sure I post all my content also on X. But I posted this. I said PayPal wanted to become a full-on bank is more evidence SoFi and Anthony Noto have a genius overall strategy and flawless execution. That's what that means. Because if you think about SoFi, the way to think about SoFi is it's a bank. Sure, it's like an online, digital first bank, but it also has a lot of components of FinTech. And so if you think about PayPal, always traditionally, it's a FinTech. But now they want to push into banking, so they're going to kind of converge. And so it's more proof, in my opinion, that SoFi's got it. Like SoFi has all these companies wanting to be them. The more I look at it, it seems like all the traditional banks are trying to become more FinTech-y, like SoFi. And it seems like the FinTechs, like a PayPal, are trying to move more in that banking direction like a SoFi. So SoFi's got it on both sides, which in my opinion is more proof that like they are really the real deal Holyfield. And if you look at the growth rates SoFi's had, they've been unbelievable. And so as a SoFi shareholder, when I heard this news, I was like, okay, this is good. From a PayPal perspective as a shareholder, I'm like, okay, good. I don't want them to get too asset heavy, but as long as they stay somewhat asset light, maybe sell off some of the loan business to other folks out there, that's fine. That's good. But from the SoFi perspective, I walked away with this news more bullish on SoFi than ever before. I'm like, oh my gosh, they've got it. They're moving in the right direction. And the way I look at some of these other players, right? Like Robinhood, I was thinking like, ooh, Robinhood maybe is a threat. The more I see what Robinhood's up to, no, they're not a threat. they're never going to be a big, and you know, I know there's a lot of Robinhood shareholders, so don't get all in your pants about this. Listen, Robinhood's clearly moving in the direction of gambling. Everybody always knew in the stock market that Robinhood's the app for if you want to trade and gamble stocks around, right? It's like serious players, you sign up for Fidelity. You sign up for other folks. You don't sign up for Robinhood. Like, no one takes Robinhood serious. Like, you show somebody a Robinhood account, they're already going to like laugh at you. Like, oh, okay, we already know what you are, right? Now they're moving in the direction they want to start doing parlays, basically, through the predictions market. They're basically becoming a sports gambling app, right? With components that you can, you know, buy stocks and things like that through, right? But it's clear as day, which I think is actually a genius strategy from Robinhood. The amount of people that love to just gamble is insane. And so if Robinhood's going to keep going down that path, good for them. Like, that's their thing, right? They're going to become the overall gambling app. Everybody in the stock market already looks at them as that's the gambling app. Now they're actually legit going that direction with Kalshi and their tie-ins and all that sort of stuff, right? And so Robinhood is not a threat when it comes to the banking system whatsoever. It's a threat if you're any sort of company and you do any sort of gambling, then it's a threat. But so SoFi is just kind of like, they got it, man. Like, they really got it. I'm so impressed. And Anthony Noto, he's been working his butt off for years behind the scenes with not a lot of respect, not a lot of, you know, hype and excitement around the stock. I mean, remember, just last year it was a $6 stock. No one cared about that company, right? And now look at it. Everybody wants to be SoFi. Okay, next up here, Micron. Why does this matter so much for AMD? Well, Micron, guess what? Their profit forecast nearly double that of Wall Street expectations. AI demand drives Micron's memory chip growth. Look at this. Micron forecasts second quarter adjusted profit at nearly double what Wall Street analysts expected on Wednesday, as prices soar for memory chips amid tight supplies and booming demand for artificial intelligence data centers. Micron said it expected adjusted profit of $842. Oh my gosh, versus estimates of $478. Good for them. I don't really care about that part. It's not important for me. I'm not a Micron shareholder, but like, if you are a Micron shareholder, this is great news. Micron's chips are fundamental components of everything from data center servers to personal computers to smartphones and vehicles. But it is also one of only 3 major suppliers, along with SK Hynix and Samsung, of what is known as high bandwidth memory, HBM chips, essential for training and deploying of generative AI models. In a conference call with investors, Micron's CEO Sanjay said that he expects memory markets to remain tight past 2026, and that in the medium term, Micron expects to meet only half to 2/3 of demand from several key customers. Okay, so this matters significantly for AMD, for NVIDIA, all those sorts of companies, right? The fact that somebody like a Micron says it can only meet half to 2/3 of demand means demand is incredibly strong. And he's talking about this remaining tight past 2026. So we're already talking about 2027 now at this point in time. Okay, if you're talking about past 2026, we're talking 27, maybe even talking 28, right? Demand still being very high. So there's nothing here when you go through this. Reuters previously reported that a memory chip crunch is pressuring smartphone makers. In an interview with Reuters on Wednesday, Micron's chief business officer declined to specify which customers would not receive chips they sought. It is inevitable in this environment that lots of customers across all segments will see an impact on their ability to procure the amount of memory they want to procure. I don't know of any customer that's getting 100% of what they want from us. And there are many, many that are getting substantially less than what they need, essentially. Micron executives said that the company is negotiating multi-year contracts with key customers and will increase its 2026 CapEx expenditures to $20 billion from $18 billion. AI-related demand remains the biggest driver for Micron. It not only drives better margins for the company, but also helps non-AI product margins as it prioritizes supply toward AI-related demand. The company is seeing strong demand from data centers, fueled by increasing spending of large-scale cloud providers. Okay, so how do I put this as simple as possible? Okay, this earnings matters. This is the last big earnings of 2025 for the AI movement. I'll put it to you as simple as this, okay? Listen, there is no smoking gun in regards to these Micron earnings. If you're looking for something like, ooh, are they going to say something that like demand's not going to be quite there after this year or something? No. You get nothing. Micron's already likely signing contracts and thinking about how they fill demand in 27 and 28. Okay, so the moral of the story is here. This is great news if you're a Micron shareholder. There's no doubt about that. Micron goes through these cycles when demand is just so high for memory that they can charge an arm and a leg, and they get it. And they make more money than you ever dreamt. But they go through those down cycles as well on the flip side. And memory pricing is very weak, and it's very, very painful. To be a Micron shareholder, a lot of times that stock can fall 40, 50, 60% in a snap of fingers. So just do keep that in mind, okay? But same thing could be said for AMD. Same thing could be said for NVIDIA. These other chip companies, they do the same thing. All of a sudden demand falls off. It happens quick. And 40, 50, 60% downside, sometimes even 70% downside, right? So the moral of the story is here, if you're banking that the chip demand's going away anytime soon, it's just not. It's just not. NVIDIA is going to put up great numbers next year. They're going to show, very nice growth. Their growth is going to start to decelerate in 26 versus 25, and it's going to decelerate significantly in 27 versus 26, but they're still growing, and they're growing demand. AMD's got insanely strong demand for years to go in the future. So AMD is going to continue to accelerate growth for quite some time. And that's going to be all great news for Micron. So the only question is, how high are the growth rates going to go? That's really the only question at this point in time. But anybody that is trying to say there's not going to be demand for chips, they're just not looking at the reality. The reality is Meta's up in CapEx, Google's up in CapEx, Microsoft, all the big dogs that you need to be spending are going to spend more than ever next year. And that growth rate will slow in terms of how much they're spending, but they got to keep spending. And so that's great news for Micron. It's great news for AMD, NVIDIA, all these stocks, right? Now, to the negative side. Okay, so Oracle, which was one of the hottest stocks in the market, 4 months ago or so. I remember the stock went up 36% in a day or something like that, right? Now it's down 40+% just in the past 2 months. Oracle's $10 billion Michigan data center in limbo after Blue Owl funding talks stall. What? Investment firm concerned about tougher debt terms and the risk of delays to the vast project. Oracle's largest data center partner, Blue Owl Capital, will not back a $10 billion deal for its next facility, as a software group faces increased concerns about its rising debt and artificial intelligence spending. Blue Owl had been in discussions with lenders and Oracle about investing in the planned 1 gigawatt data center being built to serve OpenAI in Michigan. But the agreement will not go forward after negotiations stalled, according to 3 people familiar with the matter. The private capital group has been the primary backer for Oracle's largest data center projects in the United States, investing its own money and raising billions more in debt to build the facilities. Blue Owl typically sets up special purpose vehicles which own the data center and lease it to Oracle. Larry Ellison's computing giant has deals to supply computing power with these data centers to AI groups such as OpenAI. The breakdown of funding discussions with Blue Owl leaves the financing of the Michigan's facility in doubt, as Oracle has not yet signed the deal with a new backer. According to people familiar with the matter, Blue Owl's role would probably be involved in arranging up to $10 billion of financing, making a large equity investment. Blackstone has held talks to potentially step up as a financial partner, but has not yet signed a deal to invest in Oracle's data center. People familiar with the matter say, okay. The funding turbulence points to increasing strains on Oracle's AI infrastructure strategy. The group founded by Ellison has embarked on AI data center spending spree in recent months and has aggressively tapped debt markets to build its capacity, spooking investors and prompting concerns from ratings agencies and analysts. Oracle shares have fallen 46%, oh my gosh, from their peak in September, and its bonds have also sold off. They closed 5.4% lower, blah, 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 okay? So there's 2 parts of this, okay? Listen, first off, very important I say this. This is very Oracle specific, okay? Very Oracle specific. Oracle has gone into this AI cycle with huge debt load. Why have I not bought an Oracle stock in the past? If you're a private group member, you already know this, because you remember when I was talking about Oracle a year or 2 ago, and I was like, it's interesting stock, but there's one thing that scares me. What is it? Debt. Huge debt load on that company. Their balance sheet's garbage. For considering they're a big tech company, their balance sheet is trash. Like usually when you think about big, strong tech companies, you think about some of the best balance sheets you ever see in the history of mankind. These balance sheets are incredible. Oracle is not that company. Their balance sheet, no bueno, no bueno. Usually think about low debt, super high cash loads, super high investments, and Oracle's balance sheet just is not that sort of company. So that's a problem. And so very Oracle specific. With that being said, if some of these infrastructure is not built out as rapid, it could hurt certain companies that might need that, like OpenAI, right? At the end of the day, the big players that really have the big money are going to keep spending in this space, right? It looks to me like people just want to make a better return on this. So it's not that people are willing to not fund Oracle. It looks like they just want a bigger cut of things. And guess what? When the sharks smell blood in the water, they're going to go ahead and they're going to eat. And that's exactly what's going on here. Oracle stock's going down so rapidly, right? It's lost almost half of its value from the highs it reached just a few months ago. The sharks smell blood in the water. And so they're going to pull back and they're going to be like, you know what? We want very favorable terms. We want certain guarantees. You've got the leverage over Oracle right now. Oracle does not have the leverage. They need the money bad. And everybody's pulled back now. So everybody's kind of like, that's how they do it. So what this means for Oracle is if and when they do get, they'll probably end up getting the funding for this and other projects in the future, but they're going to be at less favorable terms, which means Oracle could end up making less money, which is not ideal if you're an Oracle shareholder, right? Because you have to pay big turns on this. And there was already debate on how much Oracle is even going to make from this. If all of a sudden Oracle has to have even less favorable terms, that's tough. That's really, really tough. So it's a more Oracle specific problem. It can affect a little bit, maybe a little bit of AMD demand and NVIDIA demand, but at the end of the day, the big dogs are going to keep spending, right? Whether they fulfill that demand with Oracle or somebody else, the big dog's going to keep spending. Like Meta's going to keep buying the chips, and Google, and all these big companies, Tesla, and go down the whole list of them. So, but this is a very natural, and I did this on, I'm not sure if you guys watch the main channel or not, but I did a YouTube short on the main channel here today talking a little bit about this, and it's a normal part of the cycle. Whenever you go through some sort of mega cycle in the market that's going on, you get the FOMO stage, just like everybody's just buying. They're only looking at the positives. They don't care about the valuation, right? Then you kind of get a kangaroo stage. People start to ask a little questions about, wait, what about this? What about this? After the kangaroo stage, then you got the pain stage. And we're in the pain stage right now for this whole AI movement where people are questioning everything, right? They're questioning about what's the return here? Is this demand really going to be needed? How many chips are needed? They just keep what's the valuation of this company? Why should we pay this price? Everything's very question. Like, I don't know about that. I don't know about that. I don't know about that. Very different than even a few months ago when it was like, you just got to get in. You just got to get in, right? And so that's the stage of the cycle we're in right now. So what ends up happening after this is, and this happens at some point in the first half of 2026, in my opinion, but at some point in the first half of 2026, what you're going to see is all these AI-related stocks bottom. And then you'll see a more healthy cycle that happens in them. That's more earnings adjusted. People will be able to wrap their head around better about what actual demand is, what real growth rates are, and those sorts of things. And then they'll start to move up from there. But it's a whole game that has to be played out. Okay, and so you can't rush the game. It's just part of the game. All right, next one up here. Let's react to some Wall Street. 8,000 S&P 500 next year. Oh my gosh.
It's good to have you. It's been a minute. It's good to have you back.
Thank you for having me, Scott.
Let's just play off of what we just got from Bostic, and he's not going to vote. So it's sort of moot unless he represents a more hawkish side of the Fed. You suggest, as you're bullish for next year, that if the Fed eases further on the back of improving inflation dynamics, S&P could go past 8,000 next year. That's a pretty bullish outlook.
Yeah, so that's we're thinking of that more as an upside scenario, and that would be contingent upon the Fed easing more than just one more time. which is part of our base case. And that's why we sort of put in 7,500 as our base case, driven by a Fed that eases one more time and then basically goes into prolonged pause. If inflation dynamics do come in better than expected or better than feared, I think in that case it does open up the left side of the distribution for the Fed in a bigger way, and I do think that risky assets benefit from that.
Are you not a big believer in the whole run it hot trade that the Fed is going to be cutting, whether it's one or more times, into a strengthening economy, not a weakening one? Thus, the market should be primed to do pretty well. Your 7,500 base case is a single-digit return next year.
Yeah, I mean, I think the economy should be in good shape next year, but I also think it's a K-shaped economy. So I think there are certain segments that are running very hot, but I do think at the same time there's other segments that are actually quite lackluster. And I do think that interest rates could help, ease various parts of the economy that are under stress.
What do you make?
Wait a minute. Wait just a minute. Hold your horses. What areas are really running that hot in the economy? Okay, the AI demand, right? Okay, the chips from NVIDIA and AMD. Okay, running hot. Fair. What else is running really hot in this economy? Housing? Oh, no. Housing's cold as ice. Autos? No. Auto sector does not look like it's going through some hot phase right now. What else do we have here? Retail? No. Some retailers are doing well. Some retailers are doing horrible. Like, that just is what that is, right? Last time I checked, it was just like a month ago or so, like Target was at like multi-year lows. So it's not retail that's doing amazing in this economy. Construction? I mean, construction's okay. I don't know if it's necessarily like, boom times for the construction sector. Maybe in regards to AI data centers and that build out, maybe that is, right? But overall, big projects, I mean, it's okay, but I wouldn't call it like, super hot. So you run through it. Furniture? No. Like, you just keep running through it. And it's like, where's the super hot things in the economy? It seems to me like everything's either okay or like not okay. That's kind of what it seems like to me. Yeah.
Of the whole broadening idea, this, obviously what's taken place lately, there's anxiety over AI, and then all of these other areas of the market have been doing well. Is that a moment in time, or does that...
Even a lot of the restaurant stocks been very, very weak in regards to their earnings. So even if we look at that sector, like that's been weak. Travel, some areas been good, some areas haven't been good. It's really a case-by-case basis. Las Vegas Sands been doing well. They got a lot of properties in Macau, great property in Singapore. Wynn's been doing pretty good, but they really cater to the high end. But in terms of Vegas, my city, I live in Vegas, in terms of, strip visitation, it's actually been horrible this year compared to last year and many other years. So, there's just not really many areas of the economy that are really even hot.
Persist.
So I think the AI trade is going through a bit of a digestion and a pause, understandably so, because it has been...
Oh, you guys want to know how to make so much money? You want to know how to make so much money? Listen, become a handyman. I swear, we've reached out to so many handymen, and they're all so busy, it's ridiculous. Like, they have to, like, put you on, like, a backlog. And we've spoken to several of them. It's insane. It's insane. Like, no one like looks at like being a handyman as like, no, trust me, like you could do very well for yourself. That might be the next play. Like, I know people talk about also being plumbers, electricians, like making big money. Become a handyman. Just learn how to fix everything. People always need a handyman. You get your name around. Next thing you know, oh my gosh, you have more customers, more business than you know what to do with. Literally, like you want a handyman in Vegas? Get in line. You might be waiting weeks.
So hot, throughout much of 2025. I do think that you're seeing definitely pockets of broadening out recently. And we do think the broadening out could continue to run its course, but really only tactically short term into 1Q. You could have some of these like positive seasonals as in sort of bottom fishing beginning of January. You guys just talked about like a bit of a fiscal thrust kicking in from the OBBA side that could help the consumer. So I do think there is a number, and then I think various parts of cyclicals, if you will, or value are trading trough and trough when you think about multiples and earnings. So you could get a bit of a lift.
Like what?
So let's say parts of consumer, like low-end consumer has been really beating up a lot of these places. You think about cruise lines, restaurants, the Las Vegas trip, so...
Hey, Las Vegas trip.
Lately. right?
Recently,
Yesterday,
yes, but they're
a lot
coming
of
from
these
very
things
low
got
levels.
upgraded. Yeah.
So that's what I'm saying. Like, Home Depots of the world, like you think about like home improvement, parts of housing. So I think these areas could see a bit of a lift, but I would argue it's probably more of a tactical lift. Q1 story, as we think about the medium term 2026, we still think the big story remains centered around AI, where we think big tech hyperscalers remain very well positioned. Utilities we continue to like. Big banks we think are pretty large beneficiaries.
Home Depot, wasn't the stock 350 like years ago? I feel like Home Depot, I swear I remember that stock used to be 350, like a long time ago. Let me see HD here. Home Depot. Let me pull up a 5-year. Yeah, I mean, this stock, you can go back to 21 and the stock is 400 plus. That's the thing with it's a tough thing with retail, man. It's where money goes to die in the stock market. It really is. It's tough. Unless you can get in and bottom feed these things. Like if you can get in a retailer like when just no one wants it, maybe you can make some money there. But man, I got to say it's tough to make money in retail stocks. It really is. That's one of the toughest areas of the market to make money. That and oil and gas stocks, that's another bunch.
Of AI, and then certain parts of healthcare like pharma.
I mean, you do like large parts of the market which still are going to somehow not deliver that robust of returns. That's interesting. So, right? I mean, you like these big groups, banks and tech and other areas that would fall into that category as well. What are the big risks to your outlook then?
So I would say the risks, the big one I would say is basically the Fed. If the Fed basically closes the door to future easing earlier rather than later, I do think that markets will have a bit of a hard time digesting that. And I think this, call it broadening out trade, I do think could hit a wall in a pretty hard way in that case. And you go back into a very, very narrow leadership. Energy sector is, for instance, one area that we think is becoming increasingly decoupled from weakening oil prices, and we think will be under downward pressure. And then there's pockets of staples, there's parts of industrials, there's other parts of financials outside of banks that we don't think necessarily fare well in this environment.
Okay, next one up here, Tommy Lee.
Great to have you with us. There's a lot of things to talk about with you in terms of the skepticism now around the AI trade, skepticism around Bitcoin. Are they, in fact, related, do you think?
Related, but not related.
Yeah.
I think the AI trade, it's been a juggernaut, and we know that the visibility for the next few years is really good. But now investors are just trying to figure out how much to discount, what's the appropriate price to put. And that could drive some profit taking because they've done so well this year. On the crypto side, I think that there has been some concerns about, quantum. And then there was that huge deleveraging event on October 10th. But the crypto fundamental story, is exiting on a really high note this year. The U.S. government passed legislation and regulations favorable for crypto. And we know Wall Street has expressed a lot of interest in building products on the blockchain. So it's almost like they both have great visibility, but the price levels are just what's being uncertain.
I feel like what's common, though, with both of these stories, though, Tom, is investors questioning the growth, the trajectory of growth going forward for both of these stories. Not to say that things will contract, but maybe growth won't be as strong as we've seen. We've hit the peak sort of growth rates in terms of the story. The maximum bullishness happened with Bitcoin when the administration came on board and things started to sort of go Bitcoin's way. Maybe that was peak sort of trajectory higher when it comes to growth. Same thing with AI. Now it's a period where you're sort of wondering, will this actually get funded after we saw this massive expansion?
Yeah. Well, in crypto, the best years are definitely ahead because today there's only 4 million Bitcoin wallets with $10,000 in it. There's 900 million IRA and brokerage accounts globally that have $10,000. So that's 200 times larger market. With regard to AI, I do think that the business models need to evolve. You can't just charge $20 a month. Really AI, agentic services, but the market ends up being huge because in the U.S., it's really making 130 million existing workers into
the thing with Tom Lee, case there, listen, it's just ridiculous. It's only this percentage have $10,000 or more in Bitcoin, right? It's just, it's like me saying, of the people that invest in the stock market, only 1 out of 1,000 own AMD stock directly, and that's very bullish for AMD. Who's to say everybody wants to own AMD stock? No different than who's to say everybody wants Bitcoin. I don't need Bitcoin. I don't care. It go billion, trillion, gazillion dollars. I don't need it. I don't want it. I don't care about it. You know what? And that's a lot of people. And so, cool. Like Bitcoin can go 10,000, 100,000, million, $5. I don't care. Like it doesn't matter to me. I have no interest in buying it. Never had it. Looked into it. Researched it a million times. It just doesn't interest me. So, like whatever.
For workers. I mean, that's a several $1 trillion market just in the U.S. alone. So I think there's still opportunities.
When do you think that we're going to see the tipping point on that front? And I think arguably you're seeing it a little bit maybe on the margins right now. But do you see a step change 18 months out from now? Is that 5 years out from now? It's because there's also questions, by the way, about some of these services and how valuable they are to people right now. And I know some CTOs and others who are actually saying, we're actually not getting the value out of some of these products that we were hoping to.
Yeah, I think we're in what I'd call the bleeding edge phase, like where everything feels like the tech is in front of the applications. That happened in mobile, which I studied for 17 years, and in internet early days. Like when color phones first came out on mobile, or even keyboards, people kind of sneered and said, who's going to be using a color screen? And remember famously what happened when the iPhone was launched and how one of the biggest competitors dismissed it, saying it's just a toy.
Right.
I think we're at that phase with AI where the capabilities will blossom and then services will follow. But that, as you know...
To be fair, though, most people that saw the original iPhone were pretty mind-blowing. They were like, oh, so Steve Ballmer, laughed at it. But should that surprise us? He was a competitor. That's what happens with a lot of people when their competitor launch a product. Oh, it's a joke. They play it off like, oh, it's nothing. We got way better product. Like, yeah, that's silly. Like they're overcharging, blah, blah, blah. Like that's a typical game. Most people were mind blown when they saw the original iPhone.
The future happens faster than many expect.
So the business models of these players, which people commonly call the Mag 7 in general, need to change, then what does that do to the valuation? Are we rethinking the valuation? Because, one distinct change has definitely already happened, and that is asset light to asset heavy, asset spending on assets continues, et cetera. Is that reflected already, or does there need to be further adjustment?
I believe that AI stocks, especially stocks like NVIDIA, are going to actually re-rate higher. Because if Walmart and Costco trade at 37 to 45 times earnings because they're predictable, then NVIDIA shouldn't be 27 times. I also think the banks are really criminally undervalued right now, like a JP Morgan, because that's becoming a technology company. And in the past, people are stuck in the head that
goes back to the SoFi. JP Morgan is becoming a technology company. Isn't that interesting? That goes back to the whole SoFi thing, right? The big banks want to become technology companies. And then you got somebody like a PayPal, it's a FinTech technology company, they want to become a bank. Oh man, it all points to SoFi. It's crazy.
They should trade at 1 times book or 10 times earnings. They should trade more like a tech stock. So I think tech and financials.
Do you think that of all the banks? Or JP Morgan in particular is invested obviously heavily in tech. But if I said JP Morgan and then I mentioned a bank 10 rungs down, would you say the same thing?
Well, it depends on how sort of evangelized a bank is towards adopting AI and being tech forward.
So, on this screen right here, like is Wells Fargo on your list of tech forward banks?
Possibly. Goldman certainly is. And I think Morgan Stanley has shown a lot of evidence. So I think banks are sort of getting it, but they are really becoming technology companies.
So even at record highs?
Even at record highs.
Thanks.
As...
Goldman's 900? You gonna be flipping my flapjacks. Goldman's 900? Dang. I didn't know it made that run. Goldman 900? Even with a dead IPO market? That's impressive. That's impressive. Oh my gosh. So 5-year on Goldman, 260%. Bravo to Goldman. Wow. Yeah, in the great financial crisis, that baby got all the way into the 70s. Wow. Well, if you've been watching the channel for many years, what are the only two banking related companies I used to say, the only two banks I would ever want to own? JP Morgan, Goldman Sachs, right? And then SoFi came along, and I started buying that one last year, but those were always the only two. I said I wouldn't touch anything outside of Goldman Sachs and JP Morgan. They've been the winner chicken dinner.
Any technical strategists will tell you it's actually sometimes better to buy things at all-time highs.
True.
Not always, though.
Yeah, it depends. It depends on many various factors. He made an interesting point around NVIDIA there. And I agree with the point to a certain extent around NVIDIA. Like, it's crazy. Costco and Walmart could be valued higher on a forward P basis than somebody like an NVIDIA. On the flip side, though, there is a potential that NVIDIA's margins could go down substantially in 27, 28, as they finally have a real competitor in the market, which is AMD. And then as they get more pressure from from somebody like Broadcom with their chips in regards to working on custom chips from customers, and maybe NVIDIA's demand starts we don't need as many chips from NVIDIA this year, right? And then all of a sudden they have to play this game of like, well, why are you guys not buying our chip? Well, AMD's got a very competitive chip in the market, right, with you guys, and they're $10,000 cheaper. And then all of a sudden NVIDIA says, okay, do we have to try to undercut them? Do we try to keep our pricing strong and potentially miss out on volume? And so is there a potential where Costco's margins could plummet in the next 2 to 3 years? No. What about Walmart? No. Is there a potential NVIDIA's margins could plummet over the next 2 to 3 years? There actually is. Doesn't mean it will happen, but there's actually a potential that could happen. And that's why people are not willing to pay as much for something like a chip company like NVIDIA. Alrighty, next one.
Is all this telling us, I was talking to Guy Adami.
I understand. Well,
thanks for watching, everybody. Mad Money starts right now. What is all this telling us about the AI trade?
One of the terms we've used is the sanctity of CapEx. And I think for a long time, people felt like the CapEx spend was somehow etched in stone as it came down from the mountaintop on one of the, slabs of Fred Flintstone, like granite. It's not etched in stone. And I think we're learning that now. And I think most of the market, in my opinion, is sort of built on this CapEx spend. And if it's vulnerable, and if you start questioning the financing around it, then you have problems. I'll say this. NVIDIA, to me, is sort of ground zero. 167 was the low in September. We closed around 171 today. That's a bit of a line in the sand, but you get through there, and people are going to start talking about the reversals and moving averages being crossed. So NVIDIA is the one you have to watch in this entire thing, Brian.
All right, Tim Seymour.
So what did I tell you guys last year, right? In the beginning of this year, I said NVIDIA is stuck. And I said it's going to be stuck for the next few years at 125 to just over 200, right? And what have we seen over the past year? That's 100% on. It's stuck in that range. Between 125, when people feeling very bearish, it's going to trade all the way down. You'll see it go under 150. You'll see it approach even into that 140, 130, maybe even 125. If people get really bearish on it during a particular time period. When people are very bullish on it, you'll see it approach right around that 200 level to go just above 200. And that's just the way I view NVIDIA. And, that's the way I saw it a year ago. That's the way I continue to see it. And I think it's just a range-bound stock. Now, it's going to keep putting up great numbers, but as soon as it reaches those little over 200, people start questioning again, what about growth rates, deceleration? What about this customer, that customer?
NVIDIA down? Yeah, listen, again, down 2.5%, 3%. It's not some huge haircut. I do worry that we don't want to make too much of this, but is Oracle its own thing, or is it symbolic of something else?
Blue Owl may not love Oracle, but Blue Horseshoe does love Anacott Steel, just to be clear.
Really?
Anyway, so,
Really? That was great.
The Fast Money Wall Street trailer, by the way, Guy.
It's unbelievable.
It's a must-watch. You can find it out there on the internet. Oracle, to me...
On holiday you may celebrate.
Yes. Well, Oracle is being pushed well below the valuation. It started here, which is what's fascinating. And ultimately... they could make a decision to not be as CapEx heavy, to not necessarily chase the order flow from companies that may or may not be worth $500 billion or not. So what I think is more interesting on a day like today, this is Mr. Glass half full, is that the other 493 were flat. Effectively, that's not fair, but the equal weighted S&P is effectively flat, and those that benefit from AI may actually be having a pretty good run here. So the market is a bit over its skis, I think, in some of these trades, and I think there's a lot of momentum that still could come out here. But if you're looking to own Oracle, and unless they are going to spend like a drunken sailor, I think this is a valuation that you're getting any of the AI optionality for free.
Given their spending, I'd just be careful. You don't want to insult drunken sailors.
No, look, I mean,
because this is all going to be debt spent.
Sometimes they buy some good stuff.
Debt-fueled spending. And we're looking at a stock, Dan Nathan, that arguably has had an unbelievable run, but yet we showed the credit default swaps. There's attention being paid to Oracle. What do you make of it?
I mean, it really hasn't had an unbelievable run relative to the other names you'd associate with this trade. I mean, it kind of joined the party last year. It was a distant fourth place in this cloud business. And to your point earlier, I mean, they can spend however they want, but they don't have the money to spend. So they have to raise the debt. That's why a Blue Owl is so important to this build out for them, right? And if you think about the hyperscalers, they were already building these clouds and they were ready to build for, this AI sort of trade. And they had, many of them, their own models. And if you're not, you're Amazon, you're investing in Anthropic, you're investing supposedly in OpenAI right now. You're putting those models on your cloud service so you can sell that compute and folks, their customers can use it. The problem is, Brian, and you just said this, you remember CDS, right? Credit default swap. Well, the last time we saw this is like, okay, first inning sort of stuff if you want to go back to the financial crisis. But the last time we really focused on that, you would have thought a lot of these arrangements, a lot of these contracts between these financial institutions, you would think that there was some sort of sanctity, as Guy likes to say, about those sorts of deals they had with each other. They were until they weren't, right? And so when you think about some of this stuff, there can be some dominoes. And the other thing is, if the market is saying that Oracle is not going to be able to fulfill these contracts, from OpenAI and others, well, you would think clouds like CoreWeave would be trading much better, right?
And they're not, right? So weakness in the overall space, that will be what that's going to be. I'm sure they'll get it all figured out first half of 2026 at some point in time. Once again, the private group is closed right now, but if you want to apply to join us when we do reopen it in 2026 and kind of be at the front of the line, that will be the pinned comment down there today. Look at that headline on CNBC here today. S&P 500 slips for third day as job report sparks economic fears, are worried about the economy once again. That always seems to creep up, doesn't it? Public count, I can't complain. Today we were up over $26,000. It's been holding up pretty decent over the last, I would say 2 or 3 weeks now at this point in time. We had that big drop back in November, but over the last 2 or 3 weeks, I'm kind of happy with where the public count's at. I felt great here today. I went ahead and bought $64,000 worth of stocks today. Went for a walk. It was beautiful here in Vegas. I wore a t-shirt on my walk. I thought I should have wore shorts. It's gorgeous, man. Absolutely gorgeous day. 70 degrees, mid-December. That's why we make it through those hot summers, baby, for time periods like this. So yeah, I spent $64,000 on stocks today. We'll talk about what stocks, all those good things. Some of the stocks I bought here today are growth stocks with some major growth. Some of them are dividend stocks. I did buy one Hedge here today for my portfolio. And one of the stocks, honestly, might shock some of you guys because it's a stock I haven't bought in a long time. And I mean a long time in any significant way. So that should be interesting to share all that with you guys here today, okay? Then after we get done going through all those stocks, why I bought them, things like that, I want to talk about the fears around the economy creeping back up again. Are they justified? Should we have fears about where the economy's headed in 26 or not really? Okay, so we'll get into all that in this video here today. One thing only I need from you guys, if you could please just hit that little thumbs up button, that little icon, boom. That's all I need. For everybody that's already done that, you're my hero. And that's all I got to say about that. Additionally, if you want to see more of my videos in the future, feel free to subscribe. Hit that little subscribe button. That way, you're going to have a higher probability of seeing my videos in the future. 2 pieces of housekeeping I want to get out of the way here before we get rolling. One is I released a video last night on the channel, my predictions for the best stocks in 2026 and overall market performance. That video is a 40-minute beast going into that subject. And then this one was a phenomenal video. One of my favorite I've created this year, actually. How to scale to $10 million plus net worth. Even if you're not even remotely close to those numbers, you'll still enjoy that video. It's a gem dropper, we call it. Second piece of housekeeping is I will be going to Miami soon and going for a few days. Never been before. If you've ever been to Miami or you live in Miami, let me know what I should do, okay? I already booked a hotel at a resort, But other than that, I don't know what to do. I'm just winging it. So if you guys want to throw me some stuff in the comments section, you got some advice for me, hey, go to this place, go that place, feel free to let me know. Or if you want to send me a DM on Instagram, whatever. Okay, I appreciate y'all for doing that. Okay, alrighty, listen, you ready to get rolling? Let's get rolling. We have only 9 trading days left in 2025. So if you need to make any last minute moves here before the year end, you better get them in because the time's about out. So I felt like today was a good day to come in with the big boy buy, likely my last big boy buy of 2025. And, at the end of the day, like obviously Christmas is going to be here right around the corner. Then we got New Year's. It's just kind of one of those time periods. You start spending a lot of time with family. You kind of get a little disconnected from the market. So I figured if I'm going to come in with, one last buy for the year, let's go ahead and let's do this thing. Okay. So what are the stocks I bought? Well, first off, I bought an ETF. One. TSLZ. This is a leverage 2x against Tesla stock, essentially. I got that at $10.35. This is one I bought some of over the past, I would say, a couple months now at this point in time, or a month at least. And this one is basically just a hedge for my portfolio. If the market goes south, I believe Tesla stock will definitely go south. And so likely Tesla stock would go down significantly, then this would 2x leverage to the upside. And so it doesn't work perfectly because it readjusts each day, but roughly the direction is correct, right? And so it's kind of a little bit of a play on that. Now, in regards to Tesla, the thing I have there's a few things here, okay? Tesla makes amazing vehicles. I just bought a new Model X, phenomenal, right? I love their vehicles. I have nothing but good things to say. With that being said, they've had a lot of trouble growing their business. If we go ahead and we pull up the charts feature on 1000X, and there's, you can make a lot of reasons why Tesla's had trouble growing. Is it, Elon going political over the past few years? Like, what is it? I don't know. But the bottom line is, we can all debate about that. But the moral of the story is Tesla's had an incredible hard time selling more vehicles. There's no other way of putting it. Now look at Tesla's revenue on a trailing 12-month basis. It's completely flatlined. Now they are expected to get back to growth. That should be good, right? Now on the other side, they've also, in my opinion, have solved full self-driving, which is important. So them and Waymo clearly look like they're going to be the two companies to be out in front when it comes to robotaxi opportunity, with kind of Amazon with their Zoox product, which we have here in Vegas, kind of playing the third wheel there. Now, in regards to this business, it's way overhyped. People are way too excited about it. They believe it's going to be like Tesla's going to make so much money from this. No, they'll make money from it, but that's going to be many years out. They'll lose money likely their first several years in this business, as Waymo does. It's just the way it is, man. Whenever you go into a new business, everybody thinks, oh, we're going to make so much money. Now, you need to fight off the competition for the first few years. You need to, undercut everybody's price, and then longer term you can make money from it. And then also the technology will be commoditized as the years tick on, right? So that's just all something to kind of keep in mind there. So yeah, basically the stock has a crazy valuation on it. If the market dips in any major way, Tesla's going to go down significantly. It's way overhyped. The robotaxi opportunity will not make any money for a long time. When it does make money, it's not going to be as much as people realize. And so that's just the way it's going to be. And, all that will obviously play out. But, in the short term here, the stock has momentum. So I don't really expect to make money on this hedge in the very, very short term. It has momentum. It's a momentum trader name. And so at the end of the day, when it has momentum, people just keep kind of funnel in, and it works until it doesn't. And then when things flip to the downside, it gets pretty significant pretty quickly in regards to Tesla. Next thing you know, the stock was down 30-40% from recent highs. But, I got time to play with there. I got time with, I have 0% fear that Tesla's going to run away from me because the valuation is so ridiculous in terms of trailing 12-month P, forward P, 2-year forward P, 3-year forward P, 5-year forward P. It doesn't matter. The stock's not running from here. And so, short term, who knows? We can go 500, whatever. But over the next 6, 12, 18 months, I'm 0% scared about that. I'll end up selling that for likely a big profit, but it's probably not in the next 2 weeks. I'll just say that. Okay. Next one I bought here today is ADBE, Adobe. I bought 25 shares there, $347.66 in regards to Adobe. And this is a pretty, I would call it straightforward one in regards to Adobe. I mean, one of the best business models out there. We're looking at a 2-year forward P on this one of 14, way too low for a company with double-digit growth. Way, way too low. And so Adobe's a pretty darn simple one. I don't know if I have my projections here for Adobe. Let me see if I have them. I'll show you guys my Adobe projections. Adobe's a stock that gets a lot of hate. I don't know which one I have, ADB or the regular Adobe. But at the end of the day, it's a moneymaker. This was actually, I called this a bull case. It's not even that crazy bull. 10% revenue growth, top line, over the next 4 years on average. 12% net income growth. This was not even crazy at all. And we're talking about a 20% CAGR there. Adobe's a very misunderstood stock. People don't really realize a lot about the business. They just hate on it, and it's just kind of hilarious. But, people hate on stocks until they turn the corner, and then they love them, right? Tesla used to be like that. Like, everybody used to hate Tesla stock, make fun of it back when I was investing it like 6 years ago or whatever, right? Then it went through its big run, and then suddenly everybody was pro-Tesla, like, oh my gosh, Tesla's the best stock ever. So it's just how it is. Like, AMD actually just earlier this year got so much hate, and then obviously turned the corner in regards to that stock, and now people call it advanced money duplicator. Next stock I bought here, 20 shares of AXP, American Express, 380. American Express has one of the best business models in the world. That's the thing with these stocks I'm buying. I'm buying many of the best business models in the world. American Express certainly has one of the best business models in the world. They have a subscription-based business model at the end of the day, right? Let me see if I have my American Express numbers. I think I have them here. So they have obviously people pay to have the credit cards, several of them, right? They pay like a subscription fee each year, and American Express invests that back into member benefits and perks. And so American Express can make money through that. Obviously, all the fees merchants pay to them. American Express has several different ways they can make money from this business model. But for my base case for American Express, I have only 8% revenue growth on average from 2026 to 2029, 12% net income growth, 28 to 33 P, which is pretty fair for a business model with this sort of moat around it, 16 to 21% CAGR, significantly above the S&P 500. That's why I go ahead and stick money in a stock like Amex. I think honestly my bull case is pretty realistic as well. 10% revenue growth on average per year, 15% net income growth on average per year, 30 to 35 PE. We're talking 21% to 26% CAGR for American Express. For a business model that has the sort of safety American Express has, because you got to understand, whenever you put your money into a stock, right, it comes with risk. There's potential it doesn't work out. There's potential downside, right? American Express, very hard to see that downside. You just can't really disrupt them. They're just so strong in their market segment. So there's a lot of people that offer credit cards, but at the end of the day, man, that's one that just comes back time and time again. And if you ask me, what is the main credit card my wife and I use? American Express. American Express, it's just the best in terms of the overall profile of perks. Some credit card might beat them on one thing, but then it's just, at the end of the day, American Express, what we found is the most solid overall credit card for us. And that's even beating Chase. Like I said, there's some certain other credit cards that they might have a little bit better this or that, but they don't have an overall better product. American Express is just the easiest card for me to pull out whenever I go to buy something. I go to a restaurant, go to a coffee shop, it doesn't matter where I go. American Express is always just the easiest to do. We use a Chase credit card for a lot of like business related stuff, but American Express just ends up being number one. Next stock I bought here today, guess what it is? One of the best business models in the world, Salesforce. Ticker symbol on this one, CRM. Very misunderstood stock here. 255.12. I've been buying a lot of Salesforce stock, I would say, over the last few months now at this point in time. When it comes to Salesforce, another misunderstood stock that people just don't get it. They like to hate on it. Some of these stocks people just like to hate on, man. And, maybe they had a poor experience with the product one time or something, and it's almost comical. 2-year forward P on Salesforce of 20. We're looking at a company with double-digit revenue growth, very strong expected double-digit earnings per share growth. Let me see if I have projections for Salesforce here saved. I run projections on every single stock I own. And Salesforce, there we go. Sometimes I forget to save them, though. But here we go. So here are my Salesforce projections here. This is a pretty basic base case I have for Salesforce. That's the thing when I run my numbers. I don't want to run with some crazy projections that it's like, oh my gosh, it's going to take a miracle. I just run like very basic numbers. And I say, does this make sense to buy the stock or not? I ran them at 12% revenue growth on average, 26 to 29. I think that's very doable with how Agent Force is going to scale and how big of a component of the business that will be. Obviously, they just finished up that acquisition as well, so that's going to boost up revenue growth over the next year or two in quite a substantial way as well. 27 to 32 PE. 20% net income growth on average, very realistic. It seems like they're going to run that business lean over the coming years. I get 13 to 18% CAGR on the stock overall. Like, it's just, like, I don't need to try, like, not every stock I buy needs to be some like 10x opportunity or like, oh my gosh, this is like crazy. No, it doesn't need to be that. I just need to find great winner chicken dinners that can likely provide me returns significantly above what the S&P 500 does. And we got it, man. We got it. Like, it's fine. It's all good, man. So those type of crazy opportunities, they come around every once in a while, but I don't always need those. I need stocks that are money makers. I need business models that I can sleep well at night, and I can likely significantly outperform the S&P 500. And that's what great businesses do. Great businesses, what do? They let you sleep well at night holding them. And great businesses significantly outperform the S&P 500 over years, right? Alrighty, what's next one up here? Well, here it is. AMD stock, Advanced Micro Devices. I bought 20 shares at 208.46 here today. AMD, I wasn't planning on buying any more AMD. I really wasn't. I was not planning on buying any more AMD. But with that being said, the stock got hit recently down to 208. And I'm sitting there today doing these buys, and I'm like, dude, I got to pick up a little more AMD. And I have so many AMD shares coming out of my ears. I don't really want to buy any more AMD because I almost feel like I'm overexposed. But it's hard for me to see the stock sitting at 208 today and not step in and buy a few shares. This is my base case for AMD. Now, I have 35% on average revenue growth, right? You might think, oh my gosh, isn't that insane? Lisa Su has said she expects them to grow 35% a year for the next 3 to 5 years. And Lisa Su's a sandbagger. So when I have my base case at 35% for the next few years, just understand that's nothing crazy. That's just Lisa Su's sandbag numbers there. I won't be surprised if they come in well ahead of that with the 450 series, and then when they come out with their 500 series in a couple of years, oh my gosh. So 35% there, 45% net income growth. They should get a nice margin uptick over the next few years, and that net income margin should increase for the company. I still have them, this is the craziest thing about my base case, I have them not even getting to 20% net income margins under this assumption. 50 to 60 PE, 34% to 40% CAGR. We're talking this stock somewhere between $600 and $800, 2029. I think it's very possible. That's why it's hard for me to see AMD at 208 today and not be like, let me just snag a few shares here. And like I said, I have so many dang AMD shares are coming out of my ears. So, AMD. Next stock I bought here today is Celsius Holdings, CELH. Now, Celsius, obviously they're in a very competitive market, right? Energy drinks, very competitive. But there's really, the thing you got to realize about the energy drink space is there's really only 3 major players in this space. It's Red Bull, it's Monster, and it's Celsius. Celsius owns not only their own brand, Celsius, which is extremely popular, but they also own the Alani brand, which has blown up over the last few years and is very, very popular as well now. And then now they also own the Rockstar brand that they just acquired from Pepsi, who is running that into the ground, right? They have the Pepsi distribution. They have major international opportunity ahead, and the Monster co-CEOs are kind of on the way out, right? They're up there in age now at this point in time. The Red Bull founder passed away a couple of years ago. And so, it's really Celsius's game to grab over the next few years in this market and really just run ahead of the competition and maybe become the biggest energy drink company over the coming years. We'll see how it all plays out, but they're definitely in a very strong position. And this is a stock that I look at, in the low 40s here today, and I'm like, got to give me some more shares. Obviously, I liked it as a better buy when it was in the 20s earlier this year, and I bought a ton of shares in the 20s. With that being said, it shows you my level of confidence in this company that I can still step in and buy this stock in the 40s. This stock was I bought a ton of shares this year in the 20s, and I'm still willing to buy in the 40s. That's a big signal from me, right, that this company has some very exciting things going for it over the next 5-10 years. What the energy drink market share numbers are going to say next quarter or whatever, like, yeah, it is what it is. That stuff moves all around. And if anything, it's probably going to be positive for Celsius. But like, I like that company a lot for the next several years, right? And so that's another one. I don't have to stress over it. Almost a recurring business model. Like, people go to buy those energy drinks day in and day out. Like, if you drink Celsius, like, high probability you drink Celsius like almost every day, or certainly every work day. I remember back when I used to work at Quick Trip, the guys that would come in and buy Monsters in the morning, guess what? They came in every day and bought Monsters. The guys that would come in and get a cup of coffee came in and got cups of coffee every single day. Like, it's just that how that business model works when you're talking about caffeine products. Next stock I bought here today is Cheesecake Factory. This should not have come as a surprise. I've been buying this stock for years. I'm still buying it. And I might buy it next year as well. This is one I can't get enough shares of because it's just one of the most attractive opportunities I see in the market, certainly in the restaurant industry. When we're talking about Cheesecake brand, when we're talking about North Italia, when we're talking about Flower Child, they had an investor conference they did. They were at this. It was a Barclays investor conference that was about 2 weeks ago now at this point in time. Phenomenal. Definitely worth a listen. It's on their investor relations page. Definitely worth a listen. Definitely worth a listen if you care about Cheesecake Factory stock, right? Or you can scroll TikTok, you nerd. Do what you want to do, okay? Be cool and listen to that Barclays investor conference they had. It's free to do. You just go to their investor relations page and pull it up. If you care about cake stock, that is. It's phenomenal, man. You'll learn so much about the business and where they're at. This one might be shocking to some individuals. Meta. I bought Meta stock here today. Now, if you know me, I have the huge position in the public count, which is around, I don't know, $1 million position or whatever it is. I think it's over $1 million position in the public count for Meta, right? And so it's a significant position for me. And my cost basis in the public count's $100 something. So to see me come in and buy this stock at $658 when my cost base in the public count is $100 something speaks volumes. But that's the thing. When you come to great companies, what are they supposed to do over time? They're supposed to go up a lot over time, right? So what I'm up or down on a stock is irrelevant. What matters is when I run my projections, does it look like I'm going to make a lot of money in that stock over the coming years? And when we look at my Meta projections, have you seen my Meta projections for the stock? I can show you them. They're pretty darn exciting. I'll say that. They're pretty darn exciting. So let's go ahead and pull up Meta, and it better be better. Let's take a peek at this. Okay, so Meta. This is my base case for Meta, 15% revenue growth on average. I should take that number up, man. I should take that number up. That's low. I should have like a 17 or 18% number here for my base case. Net income growth, 18% here, 29 to 34 PE. We're talking about a stock in 2029 that is somewhere between $1,300 and $1,500, which we call over a double up between now and 2029. That, ladies and gentlemen, is very, very attractive stock. And so whatever I'm up or down on a stock, it's irrelevant over time. ELF is a good example. ELF, I've bought shares this year anywhere between like $50 and probably like $100, right? My ELF shares in the public count that I bought back in 2019 have a cost basis in the sevens. Do you know how far $50 to $100 is from $7? But it's irrelevant. All that matters is ELF a huge moneymaker for the next 5-10 years? I believe it is. And so I'm willing to step in and buy a stock like ELF at $50, $60, $70, $80, $90, $100 because I believe that could be a $500 stock long term, right? Or a $300 stock long term. So the fact that I bought it for $7 in the past, okay, cool. Doesn't matter. So same thing with Meta. The fact that the cost basis in the public count is $100 something because I loaded up on shares in 2022 when it was dirt cheap, right? Okay, whatever. It's just at the end of the day, is Meta a moneymaker over the next several years? To me, it says it is. And so therefore, I go buy that dang stock, right? So that's how I play this game. Okay, next up here, let's talk about the economy or the fears around the economy because now we're starting to have those fears creep up again about the economy. It seems to always pull up. Are they justified? Well, here's some stuff we're seeing, okay? So Adobe tracks all the business spending and things like that. And I know some people are probably like, what? I thought Adobe just built that huge business from editing photos and videos. Okay, time to get educated about Adobe and all their different business lines and things like that, okay? No, they do a whole lot more than just photos and video editing, if you didn't know, okay? So here's Adobe tracking all this stuff on a high level. Total season spend November 1st through December 1st, they actually have it up 7% year over year to $137 billion, so that's very nice growth there. As far as mobile spend, so this is on a mobile device, $73.7 billion during this particular time, that's up 7.2% year over year, so once again, significant growth there. Buy now, pay later, outstripping both, 9% year over year. Does that concern me that buy now, pay later is up more year over year than overall spend? The answer is absolutely not. Buy now, pay later is still a relatively new thing, right? So the growth should outpace that. No different than when credit cards were the new thing, right? Like, guess what? Credit card use should have been far outstripping the overall spend numbers, right? And when it comes to buy now, pay later, a lot of people, freak out about this. Oh, it's so bad. Guess what? They said the same exact thing 4 or 5 decades ago about credit cards. Oh, credit cards, these are so bad, like they're taking off. And by the way, it might have been justified. People are going to spend money they don't actually have, blah, blah, blah. Now we look at credit cards as a usual thing. That's very normal, right? Some people go out of control with credit cards and they spend way more and they get into crazy credit card debt and they're paying that off till they're in the grave, right? Other people, like myself and maybe a lot of you guys, we use credit cards because we get all the points for them. And so if you spend a lot of money and you get all those points back, it's phenomenal. And you just pay it off right away, so we never pay interest. I never pay interest on my credit cards. Everything's paid off before interest ever starts accruing. It's phenomenal. And yet I get all those points. So I during the course of a year, I can get thousands of dollars back to me for just spending, right? That I could buy those things cash, but I'd much rather just buy it with a credit card and actually get thousands of dollars returned to me in the end, right? So anyways, I just want to cover that in regards to buy now, pay later, because people freak out about it. And I'm like, this is the same stuff people said 4 or 5 decades ago about credit cards, okay? High cost of goods is causing consumers to spend less for the holidays. This is a CNBC report I saw today, literally today. Overall, 41% of Americans plan to spend less for the holidays this year, 6 points higher than a year ago. And to that I said, really? That's interesting. 41% of Americans plan to spend less. So my guess is they said, are you planning to spend about the same as last year, spend less, or spend more, right? And so if we look here, the less number was 41%, right? About the same, looks like it's about 42%. So only 16% of people are expecting to spend more money? Then why are we getting this sort of data out? Weird, huh? Isn't that weird? That's a little weird. What happened here? So this is out of the National Retail Federation. Thanksgiving holiday weekend draws a record 203 million shoppers. Something's not adding up here. So the consumers, when they do these surveys, oh yeah, we're going to spend less this year, or we're going to spend about the same. And yet, when we're seeing the actual data, it's saying, okay, if anything, you guys are more excited to go shopping this year. And if anything, it looks like you're spending actually pretty darn aggressively. Interesting. And that leads us to the consumer sentiment. The Michigan consumer sentiment, which they've been doing since the 1950s. This has been in the porta potty. It's been in the porta potty, baby. Look at how bad the consumer sentiment has been. It has been a dumpster fire. I mean, just absolute horrible in regards to this. And this is a weird thing. You're getting these surveys, these sentiment readings, and they are horrible, absolutely horrible. But yet, the world keeps turning. People keep spending. If people weren't spending, why are Visa numbers as strong as they are? Why are MasterCard numbers as strong as they are? Why are American Express numbers as strong as they are? Like, why is Apple numbers as strong as they are? Meta, 26% revenue growth in the latest quarter on a year-over-year basis? What is going on? Amazon numbers look great. Google numbers look great. So you got to ask yourself, like, why are all the sentiment surveys so bad? They all would scream like it's the worst economy ever, and yet world keeps turning. People keep spending. Earnings look great. Weird. Very, very weird. Very, very weird times. That's what I'll say about that, right? Which then could lead you to maybe there's something fishy going on. Maybe there's something political going on. This is, some people have tried to say this, like, oh, maybe the Michigan consumer sentiment numbers, maybe that's skewed. And the goal is to make Trump look bad. And so that's why that sentiment survey is so bad. No. Got to look a little deeper. Listen, the consumer sentiment, Michigan consumer sentiment, guess what? Trump's been president before, last time I checked. And guess what? The consumer sentiment when Trump was president, until Rona happened, was amazing. So if this was something that was like, oh, we're going to try to hurt Trump, or this was like anti-Republican or whatever, then why was consumer sentiment so amazing under Trump 1.0? Tell me that. Additionally, why was consumer sentiment at pretty much the lowest it's ever been in history under Joe Biden? That doesn't look very political to me. I could understand if like consumer sentiment was horrible under Trump 1.0 and then it was like sky high under Biden and then it would like went down low again under Trump. Then I could say, okay, there's something fishy going on here. But the fact that it was amazing under Trump 1.0 and was pretty much about the worst you ever seen under Biden and still in dumps, like this is just how people feel, right? Inflation is very, very taxing on the masses, right? And it's just is what it is. And so the sentiment is horrible out there, but yet the world keeps spending and, you know, people keep spending. It's weird. It's very, very weird. But it's not political. It just is what it is. Now, as far as crude oil is screaming recession. Like, look at this. Crude oil's 55? 55? Past 6 months, crude oil is down almost 28%. Screaming recession. Very, very strange. And that's where you get into this weird economy where you have crude oil just, you know, way down there. You have sentiment surveys that are horrible. You have gold continuing to show strength, which some people say, you know, you flock to gold when times get rough. But yet the stock market's near all-time highs. But then you look at Bitcoin, and Bitcoin's like down, what's Bitcoin down? 30 plus percent from its recent highs? It's weird times, man. It's weird times, and I can understand people's confusion in regards to the economy and things like that, right? But the thing you got to understand about the economy is kind of like the ocean. The waves coming in, sometimes they're a little bigger, sometimes they're a little less big, but they keep coming. And so that's the thing you got to always understand about the economy. Even if you're in a massive recession like we had in 08, 09, people are still going to spend money out there. During 2020, when the worldwide economy was shut down, people still found ways to spend money. You know, they tried their hardest to make people not spend money, and they still did. The things just keep rolling on. The economy keeps going. It keeps going. Certain times it might be a little better than other times. Certain times consumers might have a little more money to spend. Certain times people might feel really good about their financial situation. Sometimes they're going to feel like crap about their financial situation. That's going to move all around. But the moral of the story is just like the ocean, the waves keep coming and they don't stop. Sometimes they're bigger waves, sometimes they're smaller waves, but they don't stop. The waves never, ever stop, ladies and gentlemen. So do keep that in mind. And that leads me to this segment of the video, which is talking about businesses and what's really are the strongest businesses and how to think about a moat around a business, which I think is a high level subject here that I want to dive into. If you've ever heard the term moat around a business, it's basically like, you know, the defense it has against competition in the marketplace, right? And so let's say Coca-Cola. Coca-Cola is a pretty tough company to disrupt in the soda space. One, because the soda industry is not really growing. It's not really a growing category. To then come in and try to steal shelf space from Coke and Pepsi is very difficult at this point in time. Not impossible, but gosh, it's pretty darn hard. And then to get distribution. And how do you get distribution? Do you think Coca-Cola is going to want to distribute soda products that compete directly with Coca-Cola? Probably not. Do you think Pepsi wants to? Probably not, right? Like, that's probably not a goal of theirs. And so, you know, it's a tough business. So, but that's, people usually worry about it in regards to the competition, right? Somebody coming in and trying to eat this other company's lunch. I think about not just competition, I also think about a moat around a business as, can you do well regardless of the economy? If you can do well regardless of the economy, that's a huge moat around your business. You're talking about this very anti-stress stock, right? So some companies that just came to my mind when I thought about this, that not only do they fend off competition well over the years and should in future years, but also they do well regardless of the economy. Companies like Intuit. Intuit's got a phenomenal business model, TurboTax, so taxes need to always be done. So that's a strong moat regardless of the economy. They obviously have their QuickBooks product. They have other products as well, but QuickBooks, like if you have a small business, you use Intuit. Like you're just going to stay signed up for that. If your small business is doing a little better, you're still going to use Intuit. If it's doing a little worse, you're still going to use Intuit. There's no other way around it. Adobe, same exact thing. Like doesn't matter what's going on in the economy, Adobe's going to put up their numbers. People stay subscribed to their business model and it just keeps rolling on, right? Big corporations, it's like 90% of their business roughly, it just keeps rolling on. Salesforce, same exact thing. You know, people try to disrupt Salesforce time and time again. Everybody wants to be Salesforce. Who wouldn't? Like, you know, one of the best business models and one of the best company financials you'll find ever. And yet they can't disrupt it. They just keep rolling on, right? Regardless of the economy. And the economy could be great next year. Economy could be crap next year. Salesforce is still going to put up their numbers regardless. Apple. I actually even think about Apple in these terms because of their subscription side of their business model nowadays, right? And how much they make on the services side of the business. Additionally, when you think about their products and people being locked in the ecosystem, if somebody loses their AirPods and they use AirPods all the time, guess what they're going to go buy? Another pair of AirPods, regardless of the economy is bad or good. If they're locked in the ecosystem and they drop their iPhone and their iPhone breaks or they lose it or whatever, guess what they're going to go buy? Another iPhone. They're not going to go buy some other product out there. Like if they're in the ecosystem, they're not going to go get an Android phone. It's not how it works. So Apple actually has an incredible moat around the business, not just in terms of competition, but around the economy. And just being able to put up numbers regardless if the economy is good, bad, consumer sentiment's great, bad, whatever. Microsoft, same exact thing. Between their cloud business and obviously so many businesses using their suite of products, universities, students, things like that. Like, yeah, that's a company that puts up numbers regardless of the economy. Costco's another good example, right? That's one you might think, well, if the consumer's weaker, maybe they won't go to Costco as much. I mean, sentiment's been bad for years, and yet Costco's doing better than ever. Additionally, when it comes to Costco, how they actually make a lot of their money is through their membership model. And so, you know, if you buy a little less from Costco, okay, like, you know, Costco might not love that, but as long as you keep your membership, and most people keep those memberships regardless of how the economy is doing, it's good. It's good. American Express, same exact thing. They obviously cater to a higher end consumer. And so those people who generally have money don't matter what. So they stay signed up for American Express and they just have very strong products in the marketplace. And so maybe you say, well, people might not spend as much on American Express cards if the economy's rough. That's a possibility, but people still are going to keep the credit cards, right? And then if it's people with money, they're still going to be spending money. It's not like they stop spending money because, you know, business isn't quite strong. No, they keep spending. Amazon's a good, oh, that's so funny. Amazon Prime van literally drives by as I'm talking about Amazon. Amazon's a good one to think about because this is one you might think conventionally, like, there's no way Amazon could be immune to the economy. Because they have the Prime side of the business, which is also a membership model, and they have a ridiculous amount of people signed up for Prime now, and they have the cloud side of the business, which is, you know, runs a lot of the back end of the internet and many of these companies' business models. I mean, shoot, Amazon, like, at the end of the day, if my light bulb goes out, if I have a light bulb go out in this room, and I got to replace a light bulb, guess where I'm going regardless of the economy? It's going to Amazon. I'm going to Amazon right away. Like, okay, I need this type of light bulb. Boom, boom, boom. It's going to get delivered tomorrow, regardless of the economy. And so Amazon's actually got a business model that, sure, they would do a little better in a strong economy, but that could be said for all businesses. At the end of the day, Amazon, regardless of the economy, good, bad, and in between, it's still going to put up good numbers because they have that sort of moat around their business now that people are just like, they need something, they're going to Amazon to get it. I'm not the only one. There's a lot of people trained like me. Like I almost everything I think of now, if something happens around the house or I got to get this, or I'm like, oh, I got to get my son this, or my other son this, but I think about Amazon. Comes right to my mind. Next thing you know, I'm on my phone, Amazon app, boom, boom, boom. Got it ordered within 20 seconds. I didn't have to go drive to some store and then try to see if it's even in stock and, you know, all that stuff. No. I'm ordering within 10, 15, 20 seconds on my phone. That's strong. So that's also how you need to think about moats around a business, not just competition and fending off competition, but what about if the economy is not as strong, right? Sometimes those waves aren't quite as big. So that's something to keep in mind here, okay? My pinned comment down there today, my private group is closed currently. Demand was insane this year, so it's closed now for the year. We'll open it back up at some point in 2026. If you want to be among the first to, get on the wait list, so when we do open it back up, you'll be kind of the first in line. That will be the pinned comment down there. Should have made a whole lot of money in 2025, but that's a thing of the past. We're talking 2026 in this video here today. Is the market going to do well or bad in 2026? I will share my in-depth opinion on that in this video here today. What stocks are going to do the best, are going to be the best performers in 2026? I will reveal the stocks that I believe are going to do the best in 2026. And I'll also talk about some stocks that I'd be a little careful of in 2026. Additionally, we'll talk about how to make money regardless of what happens in the stock market in 2026. We just got to have a lot to go through. That's all I have for you guys for an intro today. All I need from you is just hit the little thumbs up icon. If you could do that for me, please. Everybody that's already done that, thank you so much. Just smash the little like button. And if you want to be here, subscribe to the channel, and you want to see a whole lot of more of my videos in 2026, make sure you're subscribed. It is free to do so, okay? Alrighty, ladies and gentlemen, let's get straight rolling in regards to this, okay? First off, understand the person that's recording this video right now and my perspectives on how the market will do, what stocks will do the best in 2026, right? I started this game way back then in 2008. I found this old photo of my brother and me. This was the first time we ever went to Vegas, which is obviously the place I moved to in 2015 and been living out here ever since. Look at, they were still building City Center back there. Back then I had a $2,500 net worth. I was just a little average Joe investor back then. And guess what? Today, I'm still just an average Joe investor out there, 17 years deep in the market, always long-term focus. I recorded you guys a video 2 days ago. It's unbelievable, right? How to scale a $10 million plus net worth. That is an amount I hit in early 2024. We continue to build on that over the past year or so, and we've come a long way the past 17 years, okay? So it's been a whole lot of fun, and these are my perspectives on this, okay? Listen. Very important everybody understands this. If you look at how the S&P 500 has performed the past 10 years, a lot of times by looking in the past, you can see where the future is going, okay? So in the past 10 years, S&P 500 has had 8 banger years. Banger years. We're talking double-digit gains. So 2016, almost a double-digit gainer. We'll count it as a double-digit gainer, right? If we round up 9.5%, so basically a 10% gain. 19% in 2017. We had 2019, 28%. 2020, which you would have thought would have been a horrible year, is actually a good year for the market, 16% gain. 2021, 26%. 24% in 23, 23% in 24, and so far this year, which we're almost to the end of the year, 16% gainer. That's 8 banger years. But we did have 2 bad years in there. We had 2022, where the S&P 500 went down just under 20%. And then we had 2018, where the S&P 500 was down a little over 6%. What I'm showing you right there, that is what you should usually expect in the market. You should expect 8 good years or great years, we can call them, depending upon. Some of them were really great, right? 28% gain, like that's quite a great year. 26% gain. And then you should expect 2 bad years out of every 10 years, okay? That's just how this game rolls. You can look back at previous decades. You're going to usually find that out of every 10-year span. You have 8 good years, you have 2 bad years. It's usually just kind of what happens, okay? Now, if you want to know about the best stock, some of the best stocks in the past 10 years, you look no different than Nvidia, almost a 24,000% gain the past 10 years. Look at AMD, 9,300% gain the past 10 years. Tesla sitting at a 3,600% gain the past 10 years. Axon Technologies, they make the little cameras for police officers and whatnot, 3,000, almost 3,500% gain. And then you have ANET, which is a 3,200% gainer. So talk about some life-changing stocks the past 10 years. Now, you're going to see this. If you've never seen this before, you're going to see this eventually, okay? And maybe this is the first time you've ever seen this, okay? But people always bring up this over time. And the reason I'm showing you this is I want to debunk a little something, okay, in regards to this particular little chart that was created like 100 years ago, and people believe it's gospel. And basically the way people frame it is this is going to tell you when to get out of the market, when to get in the market, when to sell your stocks, when to buy your stocks. I know it's crazy, but people literally believe in this, and it's something that was created like 100 years ago, okay? And so this A top right here, this is supposed to be years where panics have occurred or will occur again. B is years in good times, high prices, and time to sell stocks or in values of all kind. And the reason I bring up this is because look at what 2026 is. Based upon this chart, it's saying we're supposed to sell stocks in 2026. We got high prices and sell, right? And then C is years of hard times, low prices, and a good time to buy stocks, corner lots, goods, etc., and hold for the next boom, okay? Now, the reason I want to show you that is because once again, it says 2026 is going to be a year you need to sell, get out, right? Well, here's the thing, okay? If you look at this, and I want to actually kind of debunk this a little bit today, okay? Many of these time periods, you didn't have panics in the years they said you're going to have panics. You had panics around that time, but not actually in that year. And there's certain other times it said it was a great time to buy, but actually the really great time to buy was several years before or after. So for instance, 1927 here was actually 1929, okay? Here, in 1945 says there was a panic. Guess what? The S&P 500 went up 36%. 36%? If anything, that's a panic to the good side. Didn't they wrap up WW2 at that particular time as well? Here, 1981, that should not have been, the panic year. 1987 is when you had an absolute panic in the market. You had Black Monday, which I believe still to this day is the worst day in stock market history. Where's 1987 here? They didn't have that one down, right? 1981 was 4% down for the market. That's nothing crazy at all. Here it says 1999. Guess what? We didn't have a panic in 1999. We had started having issues in the stock market in 2000, and we had obviously 9/11 happen in 2001. So, but not 1999. 2019. We didn't have a panic in 2019. 2020, we had a whole big problem, right? So keep in mind, a lot of these are like several years off, right? Here, it says a great time to buy in 2005. The actual great time to buy was 2003, not 2005. The great deals were in 03, not 05. Here, it says 2012, great time to buy. It was a great time to buy, but you know when it was an even better time to buy? 2009. 2009 stocks were dramatically lower. The indexes were dramatically lower than 2012. Here it says 2023, great time to buy. Sure, it was a great time to buy, but you know what year was better? 2022, when Meta was $88, was a better time to buy, right? And so when you see something like this, just keep in mind, I don't think it has a lot of relevance. It goes viral all over social media, and people like to believe in this sort of stuff. Makes them feel good, makes them feel like there's an easy way to judge the market by some guy that created this like 100 years ago, and so therefore it's a thing. I just debunked it for you. And we go way deeper than that and keep debunking, okay? Now, the way I like to look at this game is, would stocks drive the market? And am I expecting these companies to have strong revenue growth or weak revenue growth, or let's call it revenues even go down in let's call it 2026. Well, here's my opinions. The green check marks here are basically companies I expect to have very nice revenue growth in 2026. The blues are like, they might not. I don't know. I'm unsure, right? I don't have one red. For the top 15 most important stocks in the entire S&P 500, I do not have one red there. That's great news for us for 2026. NVIDIA is obviously going to have phenomenal revenue growth. We all know that, right? They've probably already sold through all their supply for 2026. Apple's going to have great revenue growth in 2026. I wouldn't say great. It's going to have good revenue growth. One, from the services side of the business, and the iPhones of this generation are selling very, very well. Microsoft's going to have good revenue growth. They obviously have their consistent business model, plus they have their cloud business. Amazon's going to have good revenue growth. AWS is actually accelerating revenue growth right now. Plus, they have obviously the e-commerce growth. Then they have the advertising side of their business as well. Google McDougal's going to have very nice growth overall for the company in 2026. Meta's going to have good growth, nice double-digit growth. The only question for Meta is, what are they growing revenues at next year? 25%, 20%, 15%? That's really the only question. Or could they accelerate to a 30% revenue growth number? Something to keep in mind. Broadcom will have very nice growth. They're making the custom chips for a lot of these big tech companies, so they're going to have great growth rates in 2026, in my opinion. Tesla's a question mark. I could see a situation where they get back to growth in 2026. We'll see. Berkshire Hathaway is just kind of a question mark. Berkshire Hathaway should have growth in their business in 2026. Eli Lilly's a question mark. I don't really follow that company close, so I cannot speak on a high level on Eli Lilly. Walmart will have growth in 2026 as well. Their numbers have actually been, very respectable, and the consumer could get a little stronger next year, so Walmart should report solid, revenue growth in 2026. JP Morgan, same thing. Visa, same thing. Oracle, there's a lot of question marks about Oracle in regards to their debt, in regards to their long-term business model, but their numbers will be solid in 2026, in my opinion. So then alleviates a lot of, let's call it, pressure that you could have in 2026 if you had a lot of question marks about, oh, these companies might not grow or something like that, right? Now, you got to understand valuation and how this works in regards to the mechanics of the market, okay? Right now, I always like to look at a forward P basis, whether I'm looking at stocks or whether I'm looking at the market in general. Right now, on a forward P basis, we're about 23, okay? That is not cheap. It's not sky high expensive, but it's more on the expensive side. If we're looking at a spectrum here, this is more on the expensive side. We are not, ladies and gentlemen, we are not factually in a cheap market right now, okay? That is something you have to factor in. This is not a cheap market. With that being said, there's some stocks that actually are pretty attractively priced, a la Meta at a 28 forward P. Yeah, it's above the market, but they're also significantly growing much faster than an average stock in the market. Google McDougal's at a 28 forward P for double-digit growth rates. Like, that's pretty attractive. And then Amazon's actually at a very cheap forward P based upon, where that company usually trades at for forward P. So those are three companies I look at that are actually still good deals. So just keep in mind, even though the market itself is not cheap, there are stocks in the market that are actually attractively priced. Now, there goes another side of this story, right? Which are investments, current investments of mine or past investments of mine, like Tesla and Palantir. Phenomenal stocks for me, 2,000+% gainers, absolute bangers. But what we have to say is these companies are priced to the moon, okay? The valuations are out of control. Even if you look on a 2-year forward P basis, 2 years out, okay? We're not even talking forward P. We're talking 2-year forward P. Palantir is at 181 2-year forward P. Tesla's at 111 2-year forward P. And then Oklo, which a lot of people have been buying the last couple of years, Oklo, that company's basically like a pre-revenue company that, who knows, if they ever get to profitability, it would be in the 2030s at some point in time. And if they even ever scale to major revenue growth, they'll be in the 2030s at some point in time. So you have weird situations in the market for 2026, like Palantir and what that happens with that stock when the growth rates start decelerating, right? For Tesla and the valuation concerns there. For a company like Oklo that has this big valuation and it's like, who knows when and if they'll ever even make money. You have that, but you have other dynamics in the market where it's like, okay, these stocks are actually attractively priced, if you're a long-term investor out there, right? Now, there's going to be a big subject in 2026 that has started as a subject kind of over the past few months, and this is not going away. This is going to keep getting talked about in 2026. It might even potentially be a bigger subject in 26 than it is in 25. And that is depreciation. All these big tech companies are spending a fortune on what? All these AI chips from NVIDIA. And they're going to start spending very, very aggressively with AMD as well, from our understanding, right? And these chips are supposed to be written off over a 4 to 6 year lifespan. Some people believe it should be 2 to 3 years. Even Jensen's come out and said, these chips become irrelevant really, really quickly. And although they might have useful life, it's not very useful, essentially, right? And so that's a whole debate that's going on. That debate's not going to end. But the moral of the story is, these companies are spending fortunes of money on these GPUs, but they're going to have to eventually depreciate that over the next few years, which is going to hit their earnings per share. So the earnings per share of these companies will not look nearly as impressive because they're going to get hit with depreciation, okay? Just something to factor in here. Just something to factor in. So that's going to be a question mark over the market. Now, if you look at the PEG ratio, the price to earnings growth, it's actually, I would say attractively priced right now. It's not like steal deal territory for the market, but it is somewhat attractively priced. We're right around a 1.2 right now for the PEG ratio, which is nothing crazy. And keep in mind, this makes you feel a little bit better about the market than if you looked at the forward P for the S&P 500 or even a trailing 12 month of the S&P 500, right? Now, keep in mind, if you ever see the PEG ratio go under 1, you're usually getting a great buying opportunity. So for instance, in the great financial crisis, you had the PEG ratio go way under 1 right there, great buying opportunity. Additionally, you had it go under 1 right here. This is probably around 2012 right there, great buying opportunity. You had it go under 1 right here. This was end of 2018. Q4 2018, phenomenal buying opportunity. 2019 was a banger year for the market. We don't have that going on right now, okay? So do keep that in mind. One other thing I want to draw to your attention around pay ratio. This is a little off subject, but I thought, we don't talk about pay ratio that much. So I thought I would just reference this. Sometimes pay ratio can be high and it's actually a great buying opportunity because it might mean there's some sort of recession or something going on that's affecting the growth, the short-term growth of companies. But sometimes you get great deals even buying a high pay ratio. So for instance, right here, this is in 2009. 2009 was a steal deal for the market, but the PEG ratio looked sky high. You had a PEG ratio between 1.4 and 1.8, but yet it was a great buying opportunity. Right here, this is around like 2016. PEG ratio looked very, very high, but you should have been buying stocks left and right there because obviously the tax cuts were coming, right? Right here, this is, kind of let's call it late 2020. Great buying opportunity in the market in that second half of 2020, but the PEG ratio looks sky high because obviously earnings growth got destroyed in the short term. So just keep that in mind. It's a little bit of a weird thing right here as well. This was the beginning of 2023. The PEG ratio go all the way up to 2 is actually a phenomenal buying opportunity when you see the PEG ratio go up that high, usually because you have some sort of short-term dynamic that's going on that's affecting earnings growth, and that eventually gets alleviated, just as it did here, right? Think about the big tech companies at the end of 2022, their earnings growth was embarrassing. Actually, some of their earnings were going down, right? And so PEG ratio went sky high. It was actually a phenomenal buying opportunity. So just something to keep in mind in regards to PEG ratio, right? Now, there's a major thing from the government side, the big beautiful bill, obviously that got passed over the summer, right? But the positive effects of that will start being felt in 2026 and then as you go for the next few years, essentially, right? An average household savings is supposed to be about $2,900, which is significant for the average household, which means there's going to be more money spent in the economy. There's no other way of putting it. There's going to be more money spent in the economy in 2026. The economy should in theory get better. There's no guarantees. Something you're going to learn in the stock market over time and in life, there's no guarantees in this game. There's a range of outcomes. I live in Las Vegas. There's a range of outcomes that can happen at all given moments, right? And if you follow sports, there's always a range of outcomes that can happen in a game. A team could have a 20-point lead at halftime. That does not mean they're going to win the game. They're probably going to win the game, but there's a range of outcomes that can happen there, and you'll put a percentage on, what are the chances they can actually win that game or not. And so when looking at something like $2,900 for the average family and the economy should strengthen in 26, it's not a guarantee, but if we've got to put odds on it, I would put odds at like an 80% probability that the economy will strengthen considerably in 2026 versus 2025. And a big part of that is a big, beautiful bill. Keep that in mind, ladies and gentlemen. That's going to matter significantly for spending power of Americans. And you might say, well, if they save that $2,900, maybe they'll just invest it. Maybe you'll invest it, but the average American is not investing that. They will spend that money out there. They'll go use that toward a down payment on a new car. They'll go use that on going to buy a new TV, go buy some new Nikes. They'll go use that on some makeup, some beauty products. They'll go use that on a little cruise. They'll go use that on some other sort of vacation. They'll go use that on some concerts. They'll go use that on a trip to Vegas. Come to my city. That's where they'll use that money, okay? It's not getting invested. That's funny, though. That's funny. We could talk about it getting invested, but it's not getting invested, okay? No, what that also is going to do, in all seriousness, it's going to bring up something very important. It's going to bring up the consumer sentiment. The consumer sentiment has been in the dumpster for 3 years now. Started in 2022. 2023 was bad. 2024 did strengthen, but 2025 has been another dumpster ride for consumer sentiment. And even when it strengthened in 24, the consumer sentiment was still bad. The consumer sentiment's been in the dumpster for 3+ years now at this point in time. That's not normal. That very rarely happens. The last time we had consumer sentiment in the dumpster for several years was, guess when? The great financial crisis, which makes you think we basically over the last few years, we kind of been in our own great financial crisis. The difference is we had massive unemployment here, which you did not have here, but you had massive inflation. And there's two ways you can devastate consumer sentiment. One is have people not have jobs. Two is have sky high inflation. So you have a job, but you feel like you can't make ends meet. That's how you devastate consumer sentiment. So the moral of the story is we should start to come out of this. And if the economy strengthens, you got people feeling better because of big, beautiful bill. They just realize, oh, man, there's a little more money in my account than I remember being in my account last year, right? That's a good feeling to people out there. Additionally, mortgage rates are clearly on a downtrend cycle, right? Mortgage rates peaked in 2023. And since then, I think they peaked at like 7.8% on a 30-year. Since then, they've basically been on a downward trend. There's been some ups, some downs, but it's clear that the trend over the last couple of years is down. My guess is this will continue over the next year. You'll continue to see mortgage rates go lower and lower. It's not like they're going to drop off a cliff suddenly, but it'll just kind of slowly go lower and lower, right? Now, this is going to do something very important. It's going to unfreeze the housing market in 26. The housing market's been frozen for years now. Years. It's going to unfreeze it in 2026. How I see this playing out is then the housing market starts to heat up in 2027. And by the time you get into 2028 will be back in a hot housing market again. That's my personal opinion. We'll see what happens in regards to that. But that's how I see this game playing out. For the last several years, no one's been moving. The housing market's been dead. Real estate sales have been dead. Like back to great financial crisis type levels when like no one's moving, right? Which also leads back to poor consumer sentiment, because if people want to move, right, that's a good feeling. It's a good feeling to know like, oh, I could go buy a new house. Maybe I don't want to, but I could go do it. The last few years, that hasn't even been the case because prices went so sky high coming out of Rona, right? And then you had mortgage rates go sky high. People have felt like they can't even move. They're stuck. Bad for consumer sentiment, bad for spending. If people feel they're stuck, it's not good. The real estate market matters more, in my opinion, to the overall psyche of the economy in the United States of America than anything else by a mile. This has been an economy driven by housing for, since my parents were born. Okay? Since my parents were born, this was always an economy driven by housing. If housing sentiment is good, people feel pretty good about the economy. People go out there and spend. If people feel bad, it's tough, right? And so keep that in mind. That's going to be an interesting dynamic that plays out in 2026 is the thawing of the housing market, which has been dead and frozen for years, right? Now, next up here, I asked AI, how often do you basically get 4 years in a row where the stock market goes up? Because basically we've had 3 straight years where the stock market went up, 23, 24, 25. Could we have a fourth year, right? And here's what AI found. It said, basically since 1928, so basically over the past 100 years, S&P 500 has risen 3 years in a row 12 times. Okay, 12 times. Keep that in mind. Historically, 6 out of those 11 times complete it, right? Because this is the 12th time this has happened, but obviously we don't know how the stock market's going to do next year. So, 6 out of 11 of those times were followed with a positive return in the fourth year, resulting in a 4-year winning streak. This suggests a 55% chance that basically the market's going to go up again next year, which is a coin flip. So we're now at a point in time where it's a coin flip if the market's going to go up or down, right? But keep in mind, we've had streaks way longer than 4 years. So if you think like 4 years is a max, like you can't have 4 years in a row, or, okay, if we get 4 years, 5 years can't happen. Look at this. You had 9 consecutive years of positive returns in the 1990s. And remember, a lot of people are equating this time period we're in right now to guess what time period? The 1990s. 1990s was the internet revolution, and right now we're going through the AI revolution. Right? So that's something to kind of keep in mind there. If the market goes up again in 26, it'll be 4 years in a row. It's a long way from 9 consecutive years in a row, right? No, I asked something more important. I said, and this is all using Google Gemini, I said, how often does S&P 500 go up double-digit percentage 4 years in a row? This is very important. Why? Because if you look at the last 3 years, all of them double-digit percentage returns. Could you have 4 years in a row with double-digit returns, right? AI said this is actually quite rare that this ever happens, which doesn't come as a surprise to me. This has happened though, but it is a rare occurrence essentially. Since basically over the past 100 years, you had it happen once in the late 1990s, all right? You had it happen once in the early 1950s and once in the early 1940s. So it can happen, but it's more rare in regards to a double-digit return. So if you're thinking double-digit return again, just understand possible, but I would call the chances a little more slim for a double-digit return again in 2026. Okay. Now, next up here, we have a dynamic that matters significantly to the financial markets that hasn't mattered that other 100 years of data, and that is Bitcoin. Bitcoin has become a major asset in the financial markets. You can no longer deny it, right? It just is. It is what it is. Basically, every big financial institution out there pretty much offers Bitcoin offerings now at this point in time. The government has adopted it, and it's a major player in the market. But here's the thing with Bitcoin. if you look at the Bitcoin cycle, a lot of people in the Bitcoin cycle itself is expecting Bitcoin price to go down significantly in 2026. Maybe that happens, maybe it doesn't. But let's say it does happen. How does that affect the market? That could get very interesting, because if you had a dynamic where Bitcoin fell 50+%, which is basically what the Bitcoin cycle's arguing here, that could be, oh boy, that could be quite a situation, essentially, because we know there's a lot of leverage in the crypto market. We just don't know how much, but we know it's a lot, right? Additionally, you have the Japanese yen carry trade situation, and let's say Bitcoin goes down. Does that affect that? Like, there's a wide range of implications here that if Bitcoin went down, maybe it even pours into the stock market, right? Or holds back the stock market. Maybe we don't get a crash on the market like you get in Bitcoin, but maybe you get a holdback, right? And I will say Bitcoin's acting very suspect right now, because you still have a lot of big name people coming out and talking extremely positively. I just saw this clip, here just a couple days ago. Tom Lee thinks Bitcoin's still going to 200,000 next 50 days. And so you still got the big name guys out here talking about Bitcoin's going to this, Ethereum's going to this, talking it up, right? And yet you just continue to see weakness in the asset overall, which is not the best thing. When you have all these individuals that are big name people coming out and basically saying it's going to this price, it's going to this price, it's going to go up so much, and yet no one's getting excited enough to actually go out there and invest heavy money to send it up. Little troubling in regards to that matter, right? Now, if you look at Bitcoin over the past 3 months, is down 25%, while the Nasdaq's up 3%. My guess is Bitcoin has had a negative effect on the stock market, on the Nasdaq. Not enough of a negative effect that it pulled the Nasdaq into negative territory over the past 3 months. But my guess is if Bitcoin was stronger, the Nasdaq probably would have been a stronger performer over the past 3 months. So this is just something to factor in that I think is a wild card. If Bitcoin gets bad in 2026, definitely going to hold back gains in the stock market. There's no other way around it. Things are just a little too tied in nowadays in regards to all these financial assets. That leads me to gold. Gold has been the winner chicken dinner. Look at the 3-month performance of gold, 17+%. It's an old school beast. I call it the Philip Rivers of money. You guys see about Philip Rivers this weekend? Guy's a grandpa. Hadn't played a game in like 1,800 days. Went out there and played an NFL game, starting quarterback. Most insane thing I've maybe ever seen in the NFL. A grandpa, an actual grandpa playing quarterback in the NFL. I was like, that's something, right? Gold is a Philip Rivers. It has been tested throughout decade after decade, century after century. Country after country, it's been tested over time, right? And it's performing very, very well. Now, my overall opinion, given everything I just took you through there, okay? My overall opinion on 2026, what do I expect for the stock market? Listen, I am cautiously optimistic on the stock market in 2026. Cautiously optimistic. I'm not feeling like, oh my gosh, we're going to tear it up in 2026. We're going to have a 30% gain, blah, blah, blah. No. I feel like, what are my expectations? I would expect like a 4 to 9% S&P 500 type gain. Okay, cautiously optimistic. There's a range of outcomes out there for this year, right? I would love if it's a banger year in 2026. If it wants to be a 20% gainer year, 15%, S&P 500, oh my gosh, my portfolio is going to go beast mode. There's no other way of putting it. 15% for the S&P 500 means like dramatically more for my portfolios. So, if it wants to be a beast year, cool. I'm cautiously optimistic. I'm not expecting a beast year. I'm expecting kind of that 4 to 9% type return for the S&P 500 in 2026. Now, also, I would love a 20% plus crash in the market as well. I'm doubtful on this happening, right? Unless there's some sort of contagion with the Bitcoin situation. Let's say that crash actually did happen in Bitcoin. There was some sort of contagion and major margin sell-off or something like that, right? Maybe then you can make an argument that maybe we could get a big crash, some sort of black swan event. I would put it on as a low possibility. Always possible, as it is every year, but I put it on a lower possibility. But I would love it. Why would I love it? Well, if you follow me on X, which is always linked in my description area, you know why I love it, right? I just posted this on X. I said, I have $1.9 million in high yield savings. What should I buy? What should I spend the money on? Right. And, yeah, I got a lot of money around. So, if we get that big crash in 26, I'll be right there to pick up stocks at great prices. Whatever happens, happens, right? Now, what stocks do I think will do best in 2026? Then we'll get into how to make money regardless of what happens in the market in 2026. Okay. You ready? Let's go. Adobe first up. Okay. This stock has been horrible the past 5 years. No other way to put it. 27% down the past 5 years. You might think the company's done bad. No, the company's done amazing. Look at where the company's revenues were 5 years ago. Look where they are today. Look where the company's earnings per share were 5 years ago. Look where they are today. I believe Adobe's a 20% plus gainer in 2026. That is my personal opinion on that. I believe all this negativity around the stock here in 2025 will all alleviate in 2026, and people will give up on the bearish narrative, just like they did what stock? Google McDougal. Google McDougal had a million questions, blah, 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 blah. And finally, people gave up on it, and what happened to Google? Took off like a rocket ship. I believe people give up on the negative angle in Adobe as the year goes along. It's not like it'll be all the very first day of the year. No, it'll be as the year goes along. The bearishness around the stock will conclude, and then it starts to move up. And I believe by the time it's said and done in 2026, it'll be a 20% plus gainer. We'll see. Next up here, Salesforce. Another stock I expect to be a 20% plus gainer in 2026. The growth rate will start to accelerate at Salesforce. I think that's going to get a lot of people very excited. I think they'll be more clear about Agentforce and what that means for the future of the business model. I think by this time next year, you'll have very solid numbers out of that and starting to show that it matters significantly. And I think that's another stock that's caught up in a very negative narrative around it right now, about being disrupted and blah, blah, blah. And I think eventually people realize that they're not, and they're actually being a beneficiary of the AI wave, okay? 20% plus gainer, in my opinion, in 26. Next up, Fubo. $2.50 stock roughly today, right? I believe this stock comes back to life in a major way, because what's going to happen by this time next year is everything's going to be very clear for Fubo. Revenue growth, where's the profitability at, the margins, the strategy. Since they just completed the Hulu deal, there's still a lot of confusion about what that means, what's the future of Fubo, all those sorts of things, right? I believe that people will realize that Fubo's here to stay, and they're can become a huge player in the streaming space over the coming years, and the stock comes back to life in 2026. Next up, The Honest Company. It's a $2 chuck right now, right? I believe this stock exits 2026. Guess where? $4 to $6, in my personal opinion. $4 to $6 is, I believe, where it exits. There's another stock that I don't think people understand well right now. They're very focused on, they're getting out of some businesses that basically are kind of money losers for them, bad margin businesses, and they're doubling down the business on good opportunities with a great balance sheet. And Carla, that's done a phenomenal job running the company since she came over when it was looking like it might go bankrupt. They've come a long way. And so I think the stock exits somewhere between $4 and $6 in 2026. And I think people realize, okay, they're here to stay, right? Next up, PayPal. I believe this is a 20% plus gainer in 2026. PayPal, some people are saying they're trying to become a bank, and they might. The moral of the story is PayPal's got great numbers. They should continue to put up very strong numbers. And this is one I think people have more of a clear vision for in 2026 and beyond. And guess what? Let's say they become a full-fledged bank. The valuation's already at dirt cheap prices. It's at a forward P of what, 10, 11, 12? Where are we at forward P-wise? 10, 11, 12, somewhere in there? Dude, that's like legacy banking area. Horrible. And so the moral of the story is in regards to PayPal. I believe that's another one. Basically 2026 is a year that I believe a lot of these dead and forgotten stocks come back to life. That's what I believe. It's like they come out of the casket. Like the Undertaker back in the day, right? Estee Lauder, EL, next up. I believe the stock exits at $140 plus in 2026. I believe they're going to continue to show growth in the business model. The margins will continue to come up. The EPS will continue to come up. And Wall Street loves this stock. They didn't have it in the last few years because the numbers, they were bad, right? They got the strategy on point. Looks like they got social media back, kind of understanding that on a higher level and understanding they can't just rely on department stores to sell their product, right? So I believe the stock exits 140 plus. AMD. I believe the stock exits 2026 somewhere priced between $250 and $300. We'll see where it exits this year, but it should be just over $200 to exit 2025, right? So 250 to 300. I believe by this time next year, they're already going to be showing the insane growth rates. People understand AMD is a real player, and they're going to continue to put up numbers. And their numbers are going to be much, much better in 27 than they were in 26. And 26 is going to be very impressive numbers. So 250 to 300 exit, in my opinion, in 26. Nike. 20% plus gainer, in my opinion, for Nike in 2026. The company's already started to turn around the business model. I believe that's going to continue to show in 2026 as we get those numbers out in 2026. And so I believe you'll look at Nike January 1st to December 31st of 2026, and you'll see that stock be well over 20% plus gainer. Celsius Holdings, CELH, energy drink company, should exit the year somewhere in the low to mid 40s. I believe this is a 20% plus gainer in 2026. Elf Beauty, I believe this stock exits 2026 at $100 plus. Okay. Now, an important thing to understand before we get into some stocks I'd be careful of, and then, how to make money in this market regardless. The thing about those stocks I just ran you through there. Okay. Those stocks, let's say a lot of them do that 20% gain. I think they're going to do 30%, 40%, whatever. Okay. Listen, those stocks I just ran you through, those don't move the market. They don't move the market. Those are beaten down dog stocks. Some of them are, billion-dollar market cap, few billion-dollar market cap. Some are in the tens of billions. Some might be a couple $100 billion. They don't move the market. So even if those stocks do very well in 2026, like I think they're going to do well, that does not magically move the market. If you want the market to go up 15%, 20%, 25%, you know what stocks you need to have go up significantly next year? Apple, Microsoft, Nvidia, Google, Meta, Amazon, Tesla, Broadcom, those sorts of stocks, okay? Walmart, Costco, go on the list. Those are the big dogs. Those are the ones that actually move the market. The stocks I just ran you through, they are not moving the market. Even Adobe and Salesforce, if those are 20% plus gainers in 26, like I think they're going to be, guess what? That's not moving the market. It's just not. And so that's why I have modest expectations for the market overall in 26, but yet I'm expecting many of these stocks to do phenomenal, absolutely phenomenal, okay? Now, some stocks I'd be a little careful with, in my opinion, in 26 is these three stocks like these that had been the big runners the past few years, stocks like Palantir, stocks like Tesla, stocks like Oklo. I'd be very careful of those in 26 and beyond over the next few years. Those stocks were the big runners. They got insanely rich valuations, and doesn't really matter what happens with their business models over the next few years. I think they're got problems ahead in regards to valuation. The businesses are fine. They've got valuation problems in a major, major way now at this point in time, and that makes it not the play in 2026 and beyond, okay? Next up here, how do you make money regardless of what happens in this market? It goes down, goes up, whatever. I'll tell you how. It's called dividends, baby. Dividends. So in my portfolios, I have a strategy, GVD. I call it growth value dividends, where I'll invest in growth stocks, value stocks, dividend stocks. Everything serves a purpose, right? And when it comes to dividends, I'm constantly having money pour into my portfolios, my private portfolios, my public portfolios. Money's always pouring in because I always have a bunch of dividend stocks that are always paying me out money. And so regardless of what happens in the market in 2026, I don't have to take any profits next year. This year, I've taken an insane amount of profits, which is part of the reason I'm holding $1.9 million of cash, right? Because I owe the IRS a lot of money for a lot of profits I've taken this year. With that being said, I don't have to take any profits next year, and I can still have money pour into my portfolios from all the dividends I'll be receiving from all my different stocks I built up over the last, 17 years, right? And so that's something to keep in mind. When you start with buying some dividend stocks here and there, the first 5-10 years might be sleepy. But as the amounts in your portfolio gets bigger and bigger and bigger, it starts to really be significant. In 2026, I should easily clear 5 figures, if not multi-5 figures worth of dividends received, right? Without ever having to sell a stock. I should likely make multi-5 figures just in dividend income, right? I'm able to then deploy that money into stocks out there. If the market's going down, great. I get to buy at significant discounts. If the market's doing a kangaroo, there's plenty of opportunities out there. Market's going up, I'll find opportunities as well. Whatever happens, Dividends are there to help you, right? And you want to see the ultimate as far as the dividend master, right? Look no different than Buffett. Warren Buffett's company, Berkshire Hathaway, they now make over $5 billion a year in just dividend income. Imagine that. Coca-Cola alone, that's a position they really started back in like the 1980s. Coca-Cola alone pays them almost $800 million a year in just dividends. It's incredible. And so understand, when it comes to buying dividend stocks and starting to build your portfolios, with some good dividend stocks in there, the first few years might look lame. But as the amounts grow bigger, as your portfolio grows bigger, as the dividend increases come, your companies make more profits, they up those dividends, right? You hold as the years tick on. The next thing you know, all of a sudden you start making significant amounts of money. If I looked at my dividend income 10 years ago, 17 years ago, 15 years ago, it was very modest. Might have been $100, might have been a few $100, right? And now, fast forward, 2026, don't be surprised if I make multi-5 figures of dividend income. If we fast forward another 10 years in the future, don't be surprised if I'm making 6 figures plus a year, if not multi-6 figures from just dividends. That's an important thing to understand, right? Now, the other important thing to understand is think about 2036, think about 2046. 2026 is going to be a year. It's going to be a year, just as 2027 will be, 2028, be 2029, 2030. At the end of the day, keep in mind, don't get too focused on this year. Focus on what's coming over the next decade, 2 decades. Where's the stock market going over the next 20 years? I hope you know, because I certainly do. I appreciate y'all for joining me as always. Pin comment down there if you're looking to apply to our private group. It is currently closed to new members, so do keep that in mind. But if you put in your application now, we'll basically, we're creating like a wait list for when the time does come and we open the group back up. So if you want to join that wait list for when we do open the group back up, pin comment down there. Alrighty guys, much love as always, and have a great day.